Hey, my dear students, hope you guys are all doing good. Hope you guys are all perfectly fine. So, in this video, I'm going to cover the amendments for CA final audit. In the CA final audit, as you are aware, for May 2025, they have released a new version of the study material. So, in a few chapters, not many, in a few chapters here and there, a very little amendments are there, not much, little paragraphs were added, little points were added. So, I thought instead of explaining separately what are the amendments in each and every chapter, so I thought let me do one thing, all the amendments whatever are there, so whatever extra things which were added, whatever changes that have taken place, let me accumulate all that into one single file and make one video covering all that additions, so that students will have one collective source from where they can refer all the amendments. And also I thought of doing it, so this video is completely about it. So whatever the new version of the study material the ICA has released for CFNL audit for May 2025, so when you do the comparison with the older versions of the study material, so a few things are added, not many, once again I'm telling you, so not many when it comes from the concept perspective, when it comes from the chapters theory perspective. So hardly we have here very limited amount of content is there, very limited amount of changes are there, so that will try to quickly cover it. So this is one part. This is nothing but amended content, supplementary material. In the name of supplementary material, I have uploaded it. So where you can download this thing, I will share the link in the description also. So please check the description. In that description, I will give you a link from where you can download this supplementary material. And not just that, and one more major change which has taken place in the new study material is at the end of every chapter, they have added few questions, not new questions, from the existing concepts only. For every chapter they have added some 2-3 questions they have added. Like if you compare the professional ethics chapter, there they have added somewhere around some 12-13 questions they have added. So that is one major change. At the end of every chapter in the institute study material, they have added some 2-3 questions from the existing concepts only, not altogether new questions. From the existing concepts only, they have added few more questions. So what I have done is that extra questions also I have compiled from each and every chapter. As you all are aware, in the study material, when you look at the test your knowledge questions, they will give only the question, but they will give reference to the paragraph numbers. So they will ask you to go and refer to respective paragraph to find the answer. So what I thought is, let me draft the question, let me keep the question, and also respective answer also let me give it at the same place. So I thought about it. So even I have compiled all the questions along with the answers for each and every chapter. If you go with the study material, so for each and every chapter, whatever extra questions were added and what are answers for that questions, so everything I have compiled. And you will find same in the link, whatever I will give it in the description. There you will find both this PDFs. One is extra questions PDF, along with that you will also find that supplementary material PDF. So both you will find it in the description. Just open that link, you can download it and you can refer them. Okay, right. So having said that, let me start a few things. Let me start actually going into the amendments and all. So first, I will talk about audit strategy, planning and program. See, I have given here the chapter segregation as per the ICA study material. In the ICA study material, whatever chapter segregation is there, according to the chapter segregation, I have added the content here. So first, we'll start with the audit strategy, planning and program. So in this chapter, they have added one standard. In this chapter, they have added one standard newly in the CFNL study material, which is SA 450. That standard which has been newly added is SA 450, which is talking about evaluation of the misstatements identified during the audit. This is also not something new to us. This standard is actually there in the CA Inter. In the current syllabus, if you look at the CA Inter material, you will be able to find the standard SA 450, evaluation of the misstatements identified during the audit. Now, what they have done is this reference they have also included at the CA final. So once again, a basic standard, basic concepts they will have. You will not find any major or advanced concepts. Very basic. It talks about the fundamental things relating to the audit. So that whatever is there from the CA Inter, that they have added at the CA final level also. Since they have added this newly, there is a high chance the questions might get tested from the standard in the examination. So let us try to cover it. So first we will try to start with SA 450, evaluation of misstatements identified during the audit. Come on, guys. So we'll try to wind up the discussion as quickly as we could. I don't want to waste much of your time, but at the same time, I will make sure that I'm not compromising on, not rushing on the things very quickly. So I will take time wherever required. I will explain to you in a detailed manner the provisions, and wherever little discussion is there, wherever no such conceptual things are there, so there we will try to speed up the discussion. Okay, right. So what does SA 450 deal about? As you could see in the title of the chapter and the title of the standard itself, they say that SA 450 is a standard which is talking about evaluation of the misstatements identified during the audit. Evaluation means what? Analysis. You can say it as analysis. So whatever misstatements that you have identified during the audit, how to evaluate them, how to analyze them. So it is quite common generally. Okay, if we go back to the basics once again, you tell me guys, we have understood in our regular classes in a lot of detailed manner what exactly is the ultimate objective of the entire process of audit. So can you somebody tell me? So first we'll set the base, then we'll try to understand the standard. So tell me, what is the ultimate objective of the auditor? Say for example, you are a practicing chartered accountant, you have been appointed as auditor of the client X Limited. There is one client X Limited. This company came to you and told, sir, you please act as auditor for us. Okay, I agreed to that engagement. So you tell me, as a chartered accountant, once I have accepted, once I have agreed to do the audit for one of my clients, what will be my objective? So we all are aware the ultimate objective of the auditor is to express an opinion. You are required to express an opinion on what? On the financial information. So this client X Limited will have the financial information. They would have prepared the books of accounts. From that books of accounts, they would have prepared the financial statements. So these financial statements and books of accounts, which collectively we call it as financial information, that as a practicing chartered accountant, I have to verify it and I have to express my opinion on that financial information. And that opinion, as an auditor, I'm required to express that opinion on two things. Number one, whether financial statements are prepared as per applicable financial reporting framework. So I need to express my opinion whether financial statements are prepared as per applicable financial reporting framework. Basically, applicable financial reporting framework means the set of rules and regulations which you are required to follow. Like Schedule 3 and Accounting Standards is an applicable financial reporting framework for a company. Banking Regulation Act is an applicable financial reporting framework for a banking company. IRDA rules and regulations, that will be the applicable financial reporting framework for insurance company. So like that, depending on nature of the organization, depending on the form of the organization, whether financial statements are prepared as per applicable rules and regulations or not, that I have to check and express an opinion. Not just that, as an auditor, I'm also required to express an opinion whether financial statements are free from material misstatements. So whatever financial statements which are prepared by the management, generally financial statements are the responsibility of the management. That is a thumb rule. So as an auditor, we will not prepare the financial statements. Who is responsible for preparation of the financial statements? Management. So management will prepare the financial statements. They will share that financial statements with us. We are required to verify them. So one more point on which I am required to express my opinion is whether financial statements are free from material misstatements or not. So basically, I need to verify whatever financial statements which have been given to me, do they contain any material misstatement? That I need to verify. Now, here we need to elaborate. See, this current standard, whatever we are going to discuss, this SA 450, whatever we are about to discuss, that is mainly related to the second objective. Whatever SA 450 related content we are about to discuss, that is mainly related with the second objective, whether financial statements are free from material misstatements or not. This is what around this objective the standard is mainly talking about. So they use the term here, something called material misstatement. So first we need to understand what do you mean by misstatement. We need to understand what do you mean by misstatement. So you tell me guys, what do you mean by misstatement? What do you mean by misstatement? Simply if I have to put it, so misstatement means a mistake in the financial statements. What do you mean by misstatement? A mistake in the financial statements. So who will prepare financial statements? Management. So whatever financial statements which are prepared by the management, are they prepared properly or they contain any mistake? If I put it in simple terms, a misstatement means mistake in the financial statements. But this term misstatement has been technically defined. We know the standards always make the simple things complex. Simple meaning a mistake in the financial statements, but we know, right, the terminology of the standards is not straightforward. They make it pretty complex. So how they have technically defined the term misstatement, I will tell you. But by the end, even after analyzing that complex definition also, the conclusion is the same. Misstatement means a mistake in the financial statements. But let me put it before you, what is the technical definition they have given to the term misstatement. So they have defined the misstatement something like this. The difference between amount, classification, presentation, disclosure, which is there in the reported financial statements, and the amount, classification, presentation, disclosure, which is required as per applicable financial reporting framework. So if there is any difference between amount, classification, presentation, disclosure, which is there in the reported financial statements, and amount, classification, presentation, disclosure required as per applicable financial reporting framework, that difference only we call it as a misstatement. This is what the technical definition. But once again, if I try to simplify it, what they are trying to say, Sir, what do you mean by reported financial statements? The financial statements which are prepared by the management. Say, for example, in the financial statements which are prepared by the management has shown in the statement of P&L revenue as 10 CR, revenue as 10 crore rupees. But when I look at the applicable financial reporting framework, say, for example, I'm conducting audit of this client X Limited, applicable financial reporting framework for them is Schedule 3 and accounting standards. As per Schedule 3 and accounting standards, the revenue should have been 8 crores only. If you apply the principles of Schedule 3 and accounting standards, the revenue should have been 8 crores only. But the management in the financial statements, whatever they have prepared, whatever they have already prepared, in that they are showing the revenue as 10 crore rupees. So if you see here, there is a difference between the amount which is there in the reported financial statements and the amount which is there as per applicable financial reporting framework. This difference I call it as a misstatement. This difference I call it as misstatement. Or there could be a difference in classification also. There could be a difference in classification. Say, for example, the management has treated certain item as revenue expenditure in the books of accounts. But as per some accounting standard, as per Schedule 3, that item has to be classified as capital expenditure. Difference in the classification, misstatement. Or there might be a difference in presentation. Like Schedule 3 says, you are required to present the balance sheet and P&L in the vertical format. But this client has prepared the financial statements in the T format, in the horizontal format. A difference in presentation, misstatement. Or even that could be a misstatement. Even there could be a difference in the disclosures also. In the notes to accounts also, there could be a mistake. There could be a difference. So there is a difference. If there is any difference between amount classification, presentation, disclosure, which is in the reported financial statements, and the amount classification, presentation, disclosure required as per applicable financial reporting framework, this mismatch only we call it as a misstatement. That's what even I have put it in the simple terms, a mistake in the financial statements, that we are going to call it as misstatement. So the same simple meaning only, they have complicated, nothing here. And one more thing here, a misstatement can happen because of two reasons. A misstatement in the financial statements can happen because of two reasons. Misstatement can happen either because of error, or the misstatement can happen even because of fraud. So what is the differentiating factor between the two? What is the differentiating factor between error and fraud? So we all know what is the underlying intention behind that act. If something is intentional, knowingly, willfully committed, that act we call it as fraud. However, if something is done unintentionally, without any intention, without any mischieving intention, without any deception, by mistake, if something wrong happens, that I call it as error. So I think I need not dig deeper. You all are aware what is the main difference between error and fraud. So a misstatement can happen because of either error or fraud. So now if you bring from the entire perspective of the audit, if you look from a broader perspective in the audit, so once again, if I relate with the example, whatever I have told, so I am a practicing chartered accountant. I have been appointed as auditor of the client X Limited. So now what I will do, I will get the books of accounts of the client. I will get the financial statements of the client. Now I start performing audit procedures. Like I perform risk assessment procedures, I perform compliance procedures, I perform substantive audit procedures, multiple methods I'm going to use. At some places I use inquiry, at some places I use inspection, at some places I use observation, at some places I use external confirmation. So like that, multiple audit procedures I will perform. So while performing that audit procedures, once I have started performing that audit procedures on the books of accounts, on the financial statements, I will come across mistakes. I will come across misstatements. Quite common, no? So see, no business entity will be free of misstatements. Either with intention, either without intention, no matter how much bigger corporate you take. So you all can say, sir, Reliance is the best company, best internal controls, best standards they maintain. Still, even in that company also, there will be some kind of misstatements which is not avoidable. Risk of material misstatement will always be there, no? So you take any company, there will always be chances of misstatement. And as an auditor, if you have performed a proper audit procedures, if you have followed proper methods, if you have been careful, definitely you will find some misstatements. And those misstatements could be errors also. Those misstatements could be because of frauds also. Like for example, you have started verifying revenue. In the revenue, you came to know there are some misstatements. Then you started verifying expenses. In the expenses, there are multiple expenses. There are purchases. In the purchase, I did not find any misstatement. Then there are salaries. In salaries, I am able to find some misstatements. Then we have some all other expenses. There also I am not able to find any misstatement. Then I took up the balance sheet. In the balance sheet, I have verified assets. In the assets, fixed assets, no problem. In the current assets, in the inventory area, I found some misstatements. Similarly, like every item of the financial statement you will pick up, you will perform audit procedures, and by performing that audit procedures, you will find the misstatements. Now what to do with that misstatements? Now, what are your further steps? Once you find out the misstatement, what you are supposed to do? Now, what SA 450 says, is, first you have to accumulate all the misstatements, whatever you have identified. What you should do? Accumulate all the misstatements. So you should not treat every misstatement on a standalone basis. So whatever misstatements you have identified, like I have told, in the revenue various misstatements are there, in the sales some misstatements are, in the salary some misstatements are there, in inventory some misstatements are there. So as an auditor, what you are supposed to do is you are required to accumulate all that misstatements. You are required to accumulate all that misstatements and check for materiality level. So you have to accumulate all the misstatements. Now you have to start analyzing whether those now you have to start accumulating all the misstatements and you have to start analyzing that misstatements. You have to start analyzing that misstatements. Okay, these misstatements have happened. What will be the impact on the financial statements? What is the total accumulated effect of the misstatement? How it is going to have an impact? And because of that impact, what impact it is going to have on my audit opinion, on my audit reporting? So you have to start accumulating all the misstatements. When I say all the misstatements you have to accumulate, there are some exceptions also. Okay, so what are that exceptions is? So once you have identified, okay, let me elaborate this further. Once you have identified all the misstatements, you need to identify from that misstatements what are those misstatements which are clearly trivial. What misstatements are there which are clearly trivial and others. So what do you mean by clearly trivial? Trivial means what? Negligible. See, sometimes you will find some misstatements which are clearly trivial, clearly negligible. Like for example, you are conducting audit of the company, 600 crores, 6,000 crores of revenue of the company. So now what you are able to do is, while conducting the audit of Reliance Industries Limited, you are able to find that there is 100 rupees of error in the bank statements. In the bank entries, there is 100 rupees of mistake. You tell me, will you dedicate all your time and energy to investigate that 100 rupees of difference in the entire Reliance Industries Limited? No. Why? Because this 100 rupees is clearly negligible. You can ignore. Or say, for example, while I'm verifying the cash balances, I'm able to find that some 800 rupees of difference is there. Will you once again dedicate all your time and energy on this 800 rupees of the difference? No. So like that, on whatever misstatements you have identified, so you will identify all the misstatements, whatever misstatements you have identified. From those, you identify those misstatements which are clearly trivial, clearly negligible. What kind of misstatements are there that you have to identify? You ignore them. Don't unnecessarily waste your time and energy on that clearly trivial misstatements which are clearly negligible. Why you have to waste your time and energy on that? So you ignore that. So other than clearly trivial, whatever other misstatements are there, apart from clearly trivial, say for example, I'm conducting audit of Reliance. I came to know that in the cash balances, in the cash entries of the Reliance Industries Limited, I was able to find a misstatement of 2 lakh rupees. See, 2 lakh rupees might not be material. See, material is different, trivial is different. So 2 lakh rupees, this is not something which I can ignore. This is not something which I can completely ignore. So this I can't say it is clearly trivial. I can't say that. So that will fall under this other misstatement category that I will accumulate. So once again, if you follow the sequence of the steps, so what is that? As an auditor, you perform audit procedures. By performing audit procedures, you have to identify the misstatements. Whatever misstatements you have identified, you have to accumulate it. Before accumulating, you have to do one more step. So you have to identify from your misstatements, you have to do 2 classifications. One is those misstatements which are clearly trivial, and those misstatements which are others, which are not clearly trivial. So those misstatements which are clearly trivial, clearly negligible, that you can completely ignore them. Whatever other than clearly trivial are there, that you have to accumulate it. Clear, everyone? Able to understand? Right. So whatever it is, you will accumulate the misstatements. Now you will start analyzing that misstatements. See, the moment you find, and one more next step, now we are proceeding further. See, once you have accumulated misstatements, once you have accumulated all the misstatements, now do you think once you accumulated all the misstatements, immediately you will go and modify your opinion? Say for example, I found misstatements, I accumulated all the misstatements. While I accumulated all the misstatements, I came to know that the total impact of that all the misstatements accumulated is 10 CR. Total misstatements when I have accumulated, the amount is 10 CR. Now, do you think the moment I have accumulated misstatements, the moment I have found out the amount of the accumulated misstatements, will I immediately modify my opinion? So I have accumulated all the misstatements. I came to know the total amount of accumulated misstatements is 10 CR rupees. 10 CR. Do you think I will immediately go and give a modified opinion? So I have conducted the audit of this company. I came to know there is a misstatement of 10 crore. So I am giving a modified opinion. Will you give a modified opinion directly? No, you are not going to do it. So in fact, what will happen is once you have accumulated these misstatements, first thing what you should do is you have to communicate to the management. You have to go and communicate to management or those charged with governance. Boss, 10 CR worth of misstatements I have identified. 10 CR worth of misstatements I have identified. See, basically in these misstatements, errors also could be there, no? In these misstatements, errors also could be there. So what you should do is, as an auditor, what you are supposed to do is, once you have accumulated misstatements, don't immediately go and modify your opinion. First, communicate to the management and ask the management to correct those misstatements. To correct those misstatements, whatever misstatements you have accumulated, go and communicate with the management. Boss, these many mistakes I have found out. Please do rectify them in the books of accounts. Please do rectify them in the books of accounts. You should give an opportunity for the management to rectify or not. Yes, definitely, 100%. Why? Because as I have told, we can't expect every organization to be free from misstatements. As a normal process, it is unavoidable. Some misstatements will keep on happening. So once you have identified the misstatements, go and communicate with the management. Boss, these misstatements are there. These misstatements in these areas are there. Please rectify. You go and give the management. Now what management can do? Say for example, I'm just telling you in very layman terms, you found out some 100 misstatements. Those 100 misstatements you have went and communicated to the management, and you asked the management to correct it. Say for example, management corrected 60 misstatements. Management corrected 60 misstatements were corrected. So now out of that 160 misstatements will be called as corrected misstatements. See, if the management has corrected, good only, no? If the management has corrected, I have took to the notice of the management, so these 100 mistakes are there, please do rectify. They have corrected it. If they have corrected, good. You are in a comfortable position. Now what you should do, you should check once whether they have done the corrections properly or not. You should not blindly believe once again whatever misstatements management has agreed to correct, and in fact they have corrected. You have to review them once, whether they have done the corrections properly or not. You will review them once. Now out of that 100 misstatements, 60 were corrected, everything was fine, but 40 misstatements are there which are uncorrected. Management is not correcting it. Management is not correcting the 40 misstatements. Now what you should do? Is you have to determine what are these 40 will become uncorrected misstatements. Now you need to analyze what is the impact of that uncorrected misstatements. 40 misstatements management did not correct, no? So now you need to determine what is the impact of that uncorrected misstatements, and those uncorrected misstatements you have to compare it with the materiality levels, whatever you have decided. As you all are aware, at the beginning of the audit itself, as per SA 320, we set the materiality levels. We decide what is materiality, what is material, what is not material, what is overall materiality, what is performance materiality. All that we will determine at the beginning of the audit itself as per SA 320. So as per that SA 320, you would have set the materiality levels. Now whatever uncorrected misstatements are there, that you have to compare it with the materiality level. So if your uncorrected misstatements has exceeded the materiality level, whatever you have set, say for example, I set the materiality as 1 CR, but out of that 40 uncorrected misstatements, when I calculated what is the total impact of that 40 uncorrected misstatements, the uncorrected misstatements are coming to 2 lakh rupees. Since 2 CR, since my uncorrected misstatements has exceeded the materiality level, now what I will do is I will give the modified opinion. Now what I will try to do, now I will try to give modified opinion. On the other hand, say for example, I have set the materiality level as 1 crore rupees, but whatever uncorrected misstatements are there, when I have analyzed what is the total value of that uncorrected misstatements, they are only 10 lakh rupees, which is far less than my materiality levels. Then I will not modify my opinion, then I will give unmodified opinion only. Why? Because misstatements are there. I'm not saying misstatements are not there. Misstatements are there, but the effect is not material. Understood? Clear and comfortable, everybody? So this is how you arrive at an opinion. This is how you are going to arrive at an opinion. That's all, guys. I'm done with the standard. Yes, the same thing you will be able to find it in the standard also when we start reading the standard, but little bit extended stretched discussion will be there, but this is what the overall summary. So once again, if I repeat the entire process, what did I say? First, as an auditor, you perform audit procedures. By performing that audit procedures, you will find out misstatements. Those misstatements you have to identify how many of that misstatements are clearly trivial, clearly negligible, and how many misstatements are there which are not clearly negligible. So whatever clearly trivial misstatements are there, that you can ignore. Whatever misstatements which are not clearly trivial, that you have to accumulate. So after you have accumulated those misstatements, you have to communicate to the management. So once you have communicated, there could be two things. So management would have corrected the misstatements, or management could not would have corrected the misstatements. If they have corrected the misstatements, well and good. We will do once verification whether they have corrected properly or not. If they have uncorrected the misstatements, we will determine what is the total effect of the uncorrected misstatements. That we try to compare it with the materiality levels. And if it has exceeded the materiality level, whatever we have set, then we will try to give a modified opinion and express our opinion through the audit report and close our audit. Clear? That's all. This is what SA 450 says, but little bit extended things they will try to say in the standard, that we will try to read it. With this background discussion, if we start reading it, standard becomes very, very, very simple. Shall we do it, everyone? Let us do it now. So if we start reading the standard, so let me read it from the material now. So SA 450, evaluation of misstatements identified during the audit. So what do they say here? First of all, what is the objective of the standard? As we all are aware, every standard will be given with a specified objective. Even SA 450 has also been given with specified objective. Let us try to understand what is the objective of SA 450. So the objective of SA 400, the objective of the auditor is to evaluate what is the effect of misstatements identified. So first we will identify misstatements, no? So we have to analyze, evaluate in the sense we have to analyze what is the effect of all the identified misstatements. Now, next thing, whatever misstatements we have identified, we will evaluate, right? So what are clearly trivial, what are not clearly trivial, that we will evaluate. Then we will communicate, management will correct, management will not correct. Now, whatever uncorrected misstatements are there, that we have to finally evaluate. So that will be the second objective. So the objective of the auditor is to evaluate the effect of uncorrected misstatements, if any, on the financial statements. So it talks about two objectives. So as an auditor, we are required to evaluate first what is the effect of all the misstatements identified. Then after communication with the management, whatever uncorrected misstatements are there, what is the effect of that uncorrected misstatements on the financial statements, and accordingly we have to decide on our opinion. So they have given the definitions also. So what do you mean by the term misstatement? This I've already explained. Simply a mistake in the financial statements, but as we know, the standards will not give the things in a simple manner. They complicate the things, so they have complicated here also. A difference between amount, classification, presentation, or disclosure of a reported financial statement item, and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with applicable financial reporting framework. So that's what even we try to present it visually here. If there is any difference between amount, classification, presentation, disclosure, which is there in the reported financial statements, and the amount, classification, presentation, disclosure, which is required as per applicable financial reporting framework, that difference only we call it as misstatement. And the misstatement can arise from fraud, or it could also arise from errors. Now, what do you mean by uncorrected misstatements? Basically, those misstatements which are communicated to the management but not yet corrected, not yet rectified. So that we call them as uncorrected misstatements. So misstatements that the auditor has accumulated during the audit and that have not been corrected. Not corrected by whom? Not corrected by management. Auditor will not correct. Auditor will identify misstatements, accumulate, communicate. But correction is the responsibility of whom? Management. So uncorrected misstatements are those misstatements that the auditor has accumulated during the audit and have not been corrected. So first step, what is the first step as per SA 450? This I have already spoke about it. First, you have to accumulate whatever misstatements you have identified. So you would have identified misstatements in different areas, different items of the financial statements. The first step is accumulate everything. So that's what they say. The auditor shall accumulate misstatements identified during the audit other than those which are clearly trivial. This also we have clarified. So before accumulation, we have to identify the misstatements which are clearly trivial, that you can ignore, that you need not accumulate. So whatever misstatements are there which are other than clearly trivial, that only we will try to accumulate it. So that's what even in the first point they say, the auditor shall accumulate all those misstatements which are identified during the audit except those which are clearly trivial. Now in the next few lines, they talk about what is the meaning of clearly trivial. If I put it in simple terms, clearly trivial means which are clearly negligible. The auditor may designate an amount below which the misstatement could be clearly trivial and would not need to be accumulated, because auditor expects that accumulation of such amounts clearly would not have a material effect on the financial statements. So what you should do, you should set an amount, we should set a limit. Say for example, like we have set, I will say that while I am conducting audit of Reliance Industries Limited, whatever misstatements are there which are below 1000 rupees, Whatever misstatements are there which are below 1000 rupees, those are clearly trivial, those are clearly negligible. Like if a misstatement is there for 500, ignore it. Misstatement is there for 800 rupees, ignore it. So like that, every auditor, depending on various factors, depending on the size of the client, depending on the nature of the engagement, depending on various circumstances, he will set one limit below which the misstatements will be considered very clearly trivial, which you need not worry about it. Clearly trivial is not another expression for not material. See, when I say clearly trivial, I don't mean that is not material. See, not material is different, clearly trivial is different. Like if you remember once again the discussion whatever we had, say for example, I am conducting audit of Reliance Industries Limited. I found a misstatement of 500 rupees. I found this 500 rupees as clearly trivial. I will ignore it. I will completely ignore it. Say for example, I found out a misstatement of 2 lakh rupees. 1 crore is a materiality. I have set the materiality as 1 CR, but I found a misstatement amounting to 2 lakh rupees. This 2 lakh rupees is not material. This 2 lakh rupees is not material, but I will not consider it as clearly trivial. I will not ignore it. Even though this 2 lakh rupees is not material, I will not ignore it. I will accumulate it. Why? Because this 2 lakh rupees, when combined with other misstatement, that could be material. Individually, that might not be material, but I have to accumulate. Why? Because when I combine this with another kind of misstatement, say for example, like this 2 lakh, some 10 misstatements are there. The amount of 2 lakh rupees of misstatements, some 10 items are there. So when I accumulate all of them together, 20 lakhs worth of accumulated misstatement is there, no? So this I will consider. This I will not ignore it. This I will consider it. But say for example, 500 entries are there. 500 mistake is there. Like this 500, 10 entries are there. Even if I accumulate also, amount is 5,000 only. Even collectively also, it will not be material. So clearly trivial, not material, both are two different terms. Clearly trivial means I will ignore them completely. Even when I aggregated also, that will not have any impact. But when something could not be material, but I will consider it. Like 2 lakh rupees, it is not material, but this is not something which is clearly trivial. Will I accumulate this? Yes, I will accumulate this. Understood? So clearly trivial, not material, both are not the same. Both are two different terms actually. Clearly trivial means which I will ignore altogether, which I will not accumulate it. I will not worry about it. Only those misstatements I call it as clearly trivial. Next one. Matters that are clearly trivial will be of a wholly different order of magnitude than materiality determined in accordance with SA 320 and will be matters that are clearly inconsequential. They don't have any kind of consequences. They are very smaller amount and they are completely inconsequential. They will not have any kind of consequences. Whether taken individually or when you aggregate, whether judged by criteria of size, nature or circumstances. That means whether you take these misstatements individually or when you aggregate, when you look from the size of the misstatement, when you look from the nature of the misstatement, from every perspective, they are inconsequential. They don't have any consequences. They are completely negligible. That misstatements, I call them as clearly trivial. When there is any uncertainty, see, sometimes you will have a doubt. You found one misstatement, but you are getting confused whether it is clearly trivial or not material. So you are getting confused. Then what the standard has told is, they asked you to act in a cautious manner. If you are having uncertainty, if you are unable to decide whether something is clearly trivial or not, then don't take the risk. Treat it as not clearly trivial, accumulate it. When in doubt, don't take chance. Be cautious. That's what the standard has told. When there is an uncertainty, so when there is an uncertainty about whether one or more items are clearly trivial or not, when you have a doubt, don't take risk there. The matter has to be considered not to be clearly trivial. Don't ignore it, accumulate it. So to assist the auditor in evaluating the effect of misstatements accumulated during the audit and in communicating misstatements to management and those charged with governance, it may be useful to distinguish between factual misstatements, judgmental misstatements and projected misstatements. Now one more thing they say here, we can divide misstatements into 3 more categories. They have identified the misstatements into further 3 more categories. So what they have identified is, number 1 is a factual misstatement, number 2 is a judgmental misstatement, and number 3 is a projected misstatement. Sir, what is a factual misstatement? What is a judgmental misstatement? What is a projected misstatement? See, projected misstatement is something which we have discussed in our regular classes in SA 530. When we discuss the standard audit sampling, there I have explained what do you mean by audit sampling, what do you mean by projected misstatement. So what do you mean by projected? Okay, let me come from the beginning only. What is a factual misstatement? Factual misstatement means you know that there is a misstatement, something which is based on facts. Like for example, my client company has purchased. In the purchase invoice, the bill is there for 1 lakh rupees. The purchase invoice, the amount is 1 lakh rupees. But the entry which has been recorded in the books of accounts, the entry was recorded for 10 lakh rupees. I have a clear fact there. I have an invoice for 1 lakh rupees, but in the entry, the amount of 10 lakh rupees is there. Now you tell me, is it a factual misstatement or not? 100%. It is a fact. It is clearly visible. So those kind of misstatements, we call them as factual misstatements. Now, what are judgmental misstatements? Say, for example, this is something which is related to accounting estimates. The management has purchased one plant and machinery. Now they want to charge a depreciation on that plant and machinery. Management has selected SLM method of depreciation to be more appropriate. But according to me, WDV method of depreciation is more appropriate. See, SLM will be appropriate when I'm expected to use the asset uniformly throughout its useful life. But as an auditor, my understanding is this asset will not be used uniformly throughout its useful life. Year after year, its usage will get decreased because of wear and tear. So I am telling WDV method is more appropriate, but management is telling SLM is more appropriate. So here there is a judgmental misstatement. The management has made wrong judgments. Or even if I have to give even simple example, provision for bad and doubtful debts. There is one debtor who owes 1 CR of amount to the company. According to the auditor, 5% of provision for bad and doubtful debts should be created, but the management is creating only provision for 2%. Judgmental misstatement. So like this, broadly two categories. This third thing I will come to it later. Broadly two categories: factual misstatements, which are clear-cut misstatements, no confusion at all. Judgmental misstatements, these are the misstatements which will mainly happen in the area of accounting estimates and accounting policies. Now, what is projected misstatement is, this is something which I will analyze after completion of my audit. So as you all are aware, I will try to do the verification on sampling basis. I will try to do the verification on sampling basis. Say for example, there are total 10,000 purchase entries are there. Now in that 1,000 purchase, this is the entire size of the population. From that, I have taken a sample of 100 entries. On these 100 entries, I performed audit procedures. By performing this audit procedures, I found a misstatement. In these 100 items, I found some misstatement. Now I have to project. If in my sample of 100 items, this much amount of misstatement is there, what amount of misstatement could be there in my entire population? If in my 100 sample items, say for example, the sample whatever I have verified, 100 items I have verified now. So in that 100, I'm able to find 5,000 rupees of misstatement. If in my 100 sample transactions, 1,000 rupees, 5,000 rupees of misstatement is there, how much amount of misstatement could be there in my entire population of 10,000 transactions? That you will project it. How to project it and all we have discussed in the audit sampling. SA 530 we have discussed. So that projection, whatever you're doing, so based on the math, so I have found out that in my entire population there could be a chance of 75,000 rupees of misstatement. So this projected figure, this estimated amount, I call it as projected misstatement. Able to understand? So just in the point whatever we have read in the material, they're asking you to further divide the misstatements into 3 categories. What are the factual misstatements, what are the judgmental misstatements, and what is the projected misstatement? Okay, right. So I have explained it, that you can read it. Next, consideration of misstatements as the audit progresses. So as in how the audit progresses, you have to keep on considering your identified misstatements. So let us see what they're trying to say here. The auditor shall determine whether overall audit strategy and audit plan need to be revised. Sometimes because of misstatements whatever you have identified, there might be a requirement to revise your audit strategy and audit plan. Sir, when we will be required to revise our audit strategy and audit plan because of misstatements? Let us see. So the auditor shall determine whether the overall audit strategy and audit plan need to be revised if the nature of identified misstatements and the circumstances of their occurrence indicate that other misstatements may exist that when aggregated with the misstatements accumulated during the audit could be material. So when you might be required to revise your audit strategy and audit plan is, say for example, you identified some misstatements. And depending on the nature of the misstatements, depending on the circumstances in which they have occurred, I do feel that if I verify more number of transactions, I will be able to even find more amount of misstatements. And when I aggregate with the misstatements, whatever I have identified, the amount of misstatement will be material. So currently I performed some audit procedures. I found some misstatements. Those misstatements are not currently material, but I do have a strong belief that depending on the nature of the misstatements, depending on the circumstances in which the existing misstatements have occurred, if I verify more number of transactions, I will definitely identify more misstatements. Then the total misstatements could be more than the materiality level. I have that suspicion. So now you tell me, when you have that suspicion, you should increase your testing or not? If you have a suspicion that if I perform more audit procedures, I will be able to find out more misstatements, and when I club that more misstatements, the misstatement could be more than material. If I have that suspicion, you tell me, am I required to increase my testing or not? Yes. If you are required to increase your testing, are you required to go back and make changes to your audit strategy and audit plan or not? Definitely no. If you have to increase your testing, you have to make suitable changes to your audit strategy and plan also. That's all. So that is what they say. So first case, when you are required to change your audit strategy and plan is, you have identified some misstatements, and depending on the nature of that misstatements and the circumstances in which they have occurred, that is clearly indicating that there could be other misstatements which may exist, that when aggregated with the identified misstatements, they could be more than material. When you have that suspicion, definitely you have to increase your testing. If you have to increase your testing, you have to change, you have to make suitable changes to your audit strategy and audit plan. Not just that, the aggregate of misstatements accumulated during the audit approaches the materiality determined in accordance with SA 320. Or sometimes what will happen is, you have identified the misstatements, you have accumulated that misstatements. So whatever, say for example, materiality have set is 1 CR. The materiality which I have set is 1 CR. Now whatever misstatements you have identified and whatever misstatements you have accumulated, they are close to 95 lakh. That means whatever aggregate of the misstatements you have identified, that is very much closer to materiality level. They have not exceeded. That is very much closer to materiality level. Here also, don't you think you should not be taking the chance? You should be extending little bit of audit procedures. Why? Because the gap is very minimum here. If the misstatement is, if some extra misstatement is there for 5 lakh rupees, you are required to give modified opinion. So will you take the chance in the small margin? No. What you will do, you will take some extra time. You will try to increase your testing. Now, once again, if you have to increase your testing, you have to go back and make changes to your audit strategy and audit plan. Understood? So these are the two circumstances where it might be necessary for the auditor to make changes to your audit strategy and audit plan. Number one, the nature of the identified misstatements and the circumstances in which they have occurred indicate that there could be more misstatements which may exist, which could exceed my materiality level. Or number two, the aggregate of whatever misstatements you have identified, that is very much closer, that is approaching to the materiality level, whatever you have decided. There also you should not take the chance. You have to increase your testing, go back, make necessary changes to your audit strategy, plan and program, and increase that testing and be risk free. Clear? Next one. If at the auditor's request, management has examined a class of transactions and account balances or disclosures and corrected the misstatements that were detected, the auditor shall perform additional audit procedures to determine whether misstatements remain. So same as I have told, once you have identified the misstatements, you will communicate to the management. No, once you communicate to the management, if the management is correcting them, if the management told, sir, we have corrected that misstatements in so and so item, will you blindly believe it? No, you have to perform audit procedures to see whether really management has corrected all the misstatements or still any misstatements are pending correction. See, management might come and say, sir, we have corrected all the misstatements, but you should not blindly believe them. No. So what you should do, you should also perform additional audit procedures or to check whether that whatever the management is claiming, they're claiming that they have corrected everything, whether they have really corrected or something has been left out, that you have to verify. Clear? So this is what regarding consideration of identified misstatements as the audit progresses. Now coming to the next part, communication and correction of misstatements. Once again, a repeated step. Whatever misstatements you have accumulated, other than trivial, that you will accumulate, and whatever misstatements you have accumulated, first you go and communicate to the management, and management will correct them. If the management has not corrected, then what you should do? You have to first go and ask them the reasons. Sir, why are you not correcting the misstatements? You have to ask the reason, and that impact of uncorrected misstatements you have to consider on your opinion. So that's what they try to elaborate it here. The auditor shall communicate on a timely basis all misstatements accumulated during the audit with appropriate level of management, unless prohibited by law or regulation. Sometimes there will be restriction on law and regulation, then you will not communicate. If there is no restriction by law or regulation, then we have to go and communicate with the management whatever misstatements we have accumulated. The auditor shall request the management to correct, not just communication. Go and request, sir, please correct these misstatements. If management refuses, management is saying, no, we will not correct the misstatements, then what you should do? If management refuses to correct some or all of the misstatements communicated by the auditor, first the auditor shall obtain an understanding of management reasons. Don't take extreme action. First ask them the reason. Sir, why are you not ready to correct these misstatements? Why are you saying no? Try to obtain an understanding of the reasons for not making the corrections, and shall take the understanding into account when evaluating whether financial statements as a whole are free from material misstatements. So first try to get the reasons and try to consider that reasons while expressing an opinion. Next, evaluating effect of uncorrected misstatements. As I have told, so management will correct whatever uncorrected misstatements are there, that we need to evaluate now. So whether that uncorrected misstatements, whatever are there, whether they are approaching the materiality level or not, what is the total effect of that total uncorrected misstatements? That analysis we have to do, that evaluation we have to do. So that is what they are trying to say in the next paragraph. Evaluating the effect of uncorrected misstatements. Prior to evaluating the effect of uncorrected misstatements, the auditor shall reassess materiality determined in accordance with SA 320 to confirm whether it remains appropriate in the context of entity's actual financial results. So basically, if you go back to SA 320, in case if you have decided materiality at the time when you are doing the audit, if actual financial statements are not ready. Now, once again, I'm taking you back to SA 320, guys. I hope if you are thorough with SA 320, you will be able to relate with that discussion. Whatever I'm trying to say. So if you go back to our regular classes once again, I told that as per SA 320, we will set the materiality at the beginning of the audit. See, at the beginning of the audit, when actual financial statements are not ready, we can also take the benchmarks from budgets also. No? On the basis of budgeted figures also, we can determine the materiality. Say, for example, you are conducting audit of the client X Limited. Initially, when you decided the materiality level, actual financial statements are not ready. So what you have done is you have determined the materiality on the basis of budgets. Now you have done the audit, you have identified the misstatements and all. By the time you have identified the misstatements and uncorrected misstatements, all that you have identified, now you are required to evaluate. Before you do that evaluation, just to check once. By now, actual financial statements would have been ready. Initially, you determined materiality level as per budgets. Now, by the time you have come to the closure of the audit, actual financial statements are ready. Now, just to check, is there any need to revise the materiality level, whatever you have decided at the beginning? I told you one thing, say for example, if in the budgets, the budgeted revenue was 1000 CR, the company has estimated the revenue to be 1000 crores. On that basis, you have decided materiality level. Now, when actual financial results have come, the actual financial results are 950 CR. Okay, very close. No need to revise the materiality level. But say for example, budgeted revenue is 1000 crore rupees, but actual revenue is 500 CR. You tell me, can you go with that initial materiality? No. Since there is a huge gap between actuals and budgets, you need to revise your materiality level. So like that, before you evaluate what is the total effect of the uncorrected misstatements, just check once, is there any requirement to revise your materiality level as per SA 320? Yes, if there is any such requirement, revise the materiality level first, then you start evaluating the effect of uncorrected misstatements. So that's what even they are also trying to say here. So prior to evaluating the effect of uncorrected misstatements, the auditor shall reassess materiality determined in accordance with SA 320 to confirm whether it remains appropriate. Then the auditor shall determine whether uncorrected misstatements are material. Now you consider what is the total impact of that uncorrected misstatements, then compare it with the materiality level and determine whether that uncorrected misstatements are material or not, either individually or in aggregate. In making this decision, the auditor shall determine the size and nature of the misstatements. So when you are considering whether uncorrected misstatements are material or not, you should not just pay attention to the size, the amount of the misstatement, even you have to pay attention to the nature of the misstatement. Sometimes misstatement amount would be small, but the nature of such misstatement could be material. Say for example, there is one fraud has taken place. Because of that fraud, only 1 lakh amount of misstatement has happened. But that fraud is very crucial fraud that if neglected, that could lead to crores of misstatement. Such a major fraud has taken place. But luckily the amount was small. So here size wise it is not material, but nature wise it is material. So whenever you are evaluating the effect of uncorrected misstatements, don't just pay to the attention, don't just pay attention to the size, even pay attention to the nature of the misstatements, both in relation to particular classes of transactions, account balances, disclosures. That means from P&L, balance sheet, notes to accounts, from everywhere you look at. And also you need to evaluate the effect of uncorrected misstatements related to prior periods. Also check once whether there are any uncorrected misstatements in the prior period. Last year some uncorrected misstatements are there. You check whether those uncorrected misstatements are taken care in the current year. If those uncorrected misstatements are not taken care in the current year also, still that also you have to evaluate in the current year. Say for example, last year management has did some wrong accounting policy. Just check whether that has been rectified in the current year. If it is not rectified in the current year, that also you have to consider it or not. In the current year, that also you have to consider it or not. Yes. So that's why you need to check once the effect of uncorrected misstatements related to prior periods. In the prior periods, whether there are any uncorrected misstatements. If yes, have they been rectified in the current year? If not, that also you evaluate whether it is material or not. Next one. Yeah, so this is what regarding evaluating the effect of uncorrected misstatements. Then even whatever uncorrected misstatements are there, that you have to communicate with those charged with governance also. You went to the management, requested, management did not correct. So if there is a those charged with governance, if there is next higher level of authority like those charged with governance, go and communicate with them also. Sir, your management is not ready to correct these misstatements, because of which I will be required to give a modified opinion. So you have to go and communicate with those charged with governance. So the auditor shall communicate with those charged with governance in accordance with say 260 uncorrected misstatements and the effect that they individually or in aggregate may have on the opinion in the auditor's report, unless prohibited by law or regulation. Here also, unless there is prohibition by law or regulation, whatever uncorrected misstatements are there by the management, go and tell to those charged with governance and tell how it is going to impact your opinion. The auditors communicate, or the auditors communication shall identify material uncorrected misstatements individually. Each and every misstatement individually, whatever are material, everything has to be disclosed in a detailed manner. The auditor shall request that uncorrected misstatements be corrected. If the management is not doing it, request to those charged with governance. Sir, your management is not doing it. At least you make them do it. Request them. The auditor shall also communicate with those charged with governance the effect of uncorrected misstatements related to prior periods. Like we have seen above, if there are any uncorrected misstatements in the prior period, you can go and request them. Sir, last year these uncorrected misstatements are there. At least rectify them now, or else that will have an impact on our opinion. So like this, once you are done with communication with the management, if the management is not correcting it, go and communicate with those charged with governance. One more option, give it to them to rectify. Even if those charged with governance also not able to rectify it, not able to correct it, then we don't have any option. If the uncorrected misstatements have reached the materiality level, we give modified opinion. And in addition to that, you should also request written representations, SA 580. So written representations also you are required to obtain regarding what? The auditor shall request a written representation from the management and where appropriate from those charged with governance also, whether they believe that the effects of uncorrected misstatements are immaterial. In case if the management did not correct the misstatements, ask the management to give a written confirmation that whatever uncorrected misstatements are there, those will be immaterial either individually or in aggregate to the financial statements as a whole, and even a summary of all such items should be also included. In case if the management is not correcting it, say for example, if I go to the management and say, sir, correct these misstatements, management is telling, no sir, these are all silly misstatements, we will not correct it because these will be immaterial. Don't just get their oral confirmation, ask them to put it on paper. Ask them, sir, you are telling you are not correcting these misstatements because these are immaterial. No, keep it on the paper, write it, affix your stamp and signature, and then give it to me. So ask them the written representation. And finally, regarding that misstatements and all, you need to add some things in your documentation as per say 230. So what should be included in the documentation regarding misstatements? The audit documentation shall include the amount below which misstatements will be recognized as clearly trivial. I told you at the beginning, you have to decide one limit, no, below which the misstatements will be considered clearly negligible. So what is that limit? You have decided that you have to document. How you have decided that limit? Include in your documentation. All misstatements, and also include in your documentation all misstatements that you have accumulated during the audit and whether they have been corrected or not. Nothing but in your documentation include list of all the misstatements, how many of them are corrected, how many of them are not corrected. And what is your final conclusion? The auditor's conclusion as to whether uncorrected misstatements are material individually or in aggregate, and what is the basis for your conclusion. So these extra things also should form part of your documentation. Understood? So this is what regarding SA 450. And this is one standard we anyhow exhaustively discuss at the CA inter level. But now they have told it at the CA final level also. I hope you guys are able to read it and you guys are able to understand it in a correct perspective. And if at all any question gets tested from the standard, I hope you will all be able to answer in a proper manner. Clear? Understood everybody? Right. So since we have successfully completed SA 450, the next thing which we will pick up for discussion, the next chapter which we'll pick up for discussion of the amendments is specialized areas. Nothing but SA 800 series. See, in the SA 800 series also, there are a few things which were newly added. But I know many of the people are getting worried about this SA 800 series. So they do feel that when they look at the study material, they might feel that many significant changes have taken place in SA 800 series. So people are very much worried. They are of a notion that SA 800 series has undergone so many drastic changes. That's what the perception, guys. But frankly speaking, very little changes are there. Very little changes. I will prove it. So when we actually start reading the discussion, you will get to know about it. And even if you look at this chapter might look little bit lengthy in this supplementary material, major pages will be taken up by this chapter. See, that also will give you a notion that okay, these chapter might have undergone drastic changes, but not actually. See here, in between the lines, they have given some amendments. So in between the paragraphs, they have added a few lines. So that's why if I just give you that amended line, if I just give you that amended sentence, you will not be able to get the context. So that's why what I have done is all the relevant paragraph I have given. So if in an entire paragraph, if some 2-3 lines were added, I can't just give that 2-3 lines in the supplementary material. Why? Because that will not give you context. You will not know where to read the sentences to which paragraph it relates. So that's why what I have done is whatever paragraph contains the amendment, so that entire paragraph I have reproduced it here. So don't think that everything which is given here is an amendment. In order for your identification, I have given some content in the green color. As you are able to see, I have given a few paragraphs in the green color. Only that is amendment. Whatever paragraphs which are there in green color, that is only amendment. So why I have given this extra, this content, why I have given it is because to give you context. So where this amendment is falling in place, in which paragraph it is falling in place, to make you understand, to make you give a better perspective, I have reflected the entire paragraph, but amendment portion is very limited, very easy only. If I have to summarize in one line, what exact kind of changes have taken place in the SA 800 series. So guys, as you all are aware, in SA 800 series, we have discussed 3 standards. So what are the 3 standards? So first one is SA 800, which is talking about audit of financial statements prepared in accordance with special purpose framework. Basically, in the SA 800, you will try to understand special purpose financial statements audit. In case if you are called upon to conduct audit of the financial statements which are prepared as per special purpose framework, how to do that audit, how to do that reporting, what special considerations you have to keep in mind, that is discussed under SA 800. Then we have discussed SA 805, which is talking about if you are asked upon to conduct audit of a single financial statement, like some client is asking you to do only P&L audit, or some client is asking you to do only balance sheet audit, or they might be asking you to conduct audit of a specific element, accounts or items of the financial statements. Like a client is coming and asking you to conduct audit of only revenue. A client is coming to you and asking to conduct audit of only trade receivables. So how you should handle such assignments? So handling audits of single financial statements or specific elements, accounts or items of the financial statements, that we have covered in SA 805. Then we have discussed SA 810 also. SA 810 talks about how to conduct audit of summary financial statements. So there will be complete financial statements. From that complete financial statements, sometimes the entities might be under an obligation to prepare summary financial statements. In case if you are called upon to conduct audit of the summary financial statements, how to conduct such audit engagements, that what SA 810 says. So basically, in the specialized areas, we discussed 3 standards: SA 800 talking about special purpose financial statements, SA 805 talking about single financial statement or specific element of the financial statement. Then we have SA 810, which is talking about how to conduct audit of the summary financial statements. So now, in all these standards, they say us how to take up these engagements and how to give the audit reports So mainly the discussion is about how to conduct audit, what special things we have to keep in mind, and how we have to give the audit report. So where this new changes have taken place, where these amendments have come is when it comes to the area of the audit report. So previously what they have done is when we are conducting audit of any of the special engagements, we will prepare the audit report. While preparing audit report, they have given references only to SA 700 and SA 705. Only they have given reference to SA 700 and SA 705. But if you are aware, for normal audit engagements, we have few more standards under 700 series. Like we have SA 701, which is talking about key audit matters. We have SA 706, which is talking about emphasis of matter or other matter paragraph. We also have SA 720, other information, which is published along with the financial statements. So like that, we have discussed a few more standards in 700 series. Like 701 we have discussed, 706 we have discussed, 720 we have discussed, mainly regarding that supplementary information and all. So these 3 standards also have been included in the 700 series. But till now, whatever standards are there, SA 800, 805 and 810, they did not refer to this content. In the audit reports which you give for special purpose financial statements or single financial statement or specific element or summary financial statements, they did not give references to SA 701, 706 and 720. Now what they have told is when you are doing these engagements, when you are giving audit reports on these engagements, in case if you are required to include in that reports key audit matters, SA 701 requirements also will become applicable. In case if you are doing the engagements, any of the special engagements you are doing, and you are required to include emphasis of matter or other matter paragraph, then SA 706 also will become applicable. In case if this special engagement, like for example, if you are conducting audit of special purpose financial statements, along with this special purpose financial statements, some other information is also getting published, we need to check whether that information which is there in special purpose financial statements and other information, whether they are consistent or not. Basically, whatever we do in SA 720, generally financial statements will be published along with annual reports, no? So we need to check whatever information which is there in the financial statements and annual report, both are consistent or not. If not, we are required to take some action. So what actions you are required to take, that is discussed under SA 720. Now they bring the same implications here. Like if you are conducting audit of special purpose financial statements, along with the special purpose financial statements, some other information is also getting published. So we need to comply with the requirements of SA 720. We need to check whether they are consistent or not, whether they are matching or not, which requires a change. So SA 720 requirements you have to consider. Similarly, you are conducting audit of a single financial statement or specific element. Along with that, some other information is also getting published. We need to check whether both are consistent or not, which requires modification. There also SA 720 requirements will come and become applicable here. Similarly, if you are conducting audit of summary financial statements, if that summary financial statements is getting published along with other information, here also we need to check the consistency, whether both are matching or not. If there are any differences, we have to address it as per the requirements of SA 720. As per the requirements of SA 720, this is what the major change. This is what the major change. Nothing extra you'll be able to find it here. Here and there some minute tweaking they have done, but overall this is what the amendment here. Remaining all the things remain the same. So the only changes earlier, while you are conducting the special engagements, whatever audit reports you give under these respective standards, they did not contain reference to SA 701, 706 and SA 720. Now they have added that references also. That is the only changes which you will be able to experience. So going forward, when we read it, you will get the better clarity. So you need not worry, guys. There are no such significant changes which have taken place. You need not relearn the entire standards, SA 800, SA 805, SA 810. You need not relearn the entire standards. Just if you pay attention to these minute things which have added now, that alone will be enough. So I will quickly take you through the content. Okay, so please stay with me. For the 15-20 minutes will not take much of a time. So within that 15-20 minutes, we'll try to wind up this specialized areas related amendments also. Right. So first we will take up SA 800, which is dealing with special considerations conducting audit of financial statements prepared in accordance with special purpose framework. So in this particular standard, what things have been amended is, see, there will be one paragraph. If you go to the main material, you will find one paragraph regarding applicable financial reporting framework. Basically, you are required to check as per SA 700 whenever you are conducting audit of special purpose financial statements. We need to check whether that special financial statements are prepared as per applicable financial reporting framework. So whatever applicable financial reporting framework is there, whether that special purpose financial statements are prepared as per applicable financial reporting framework or not, that we need to check. So this point is already existing. So SA 700 requires the auditor to evaluate whether financial statements adequately refer or describe the applicable financial reporting framework. Similarly, in the case of financial statements prepared in accordance with the provisions of a contract, sometimes in the contract they will tell you the applicable financial reporting framework. What are the terms and conditions according to which you are required to prepare financial statements? They will say it in the contract. In case if you are preparing special purpose financial statements and that special purpose framework is given in the contract, then what you are supposed to do? Then the auditor shall evaluate whether financial statements adequately describe any significant interpretations of the contract. So in this contract, whether any interpretations are there, whether any major interpretations are there, that also you have to clearly describe where in your audit report. Next one. And also SA 700 deals with the form and content of the auditor's report. Even when you are conducting audit of special purpose financial statements also, you are required to give audit report, no? How you will give audit report? According to the requirements of SA 700. In the case of an auditor's report on special purpose financial statements. So if you are giving audit report on the special purpose financial statements, what should be there? What things you have to focus in your audit report? Number one, the auditor's report shall also describe the purpose for which financial statements are prepared. For what purpose the special purpose financial statements are getting prepared? For whose purpose it is getting prepared? That you have to explain. And also, who will be the intended users? As we all know, special purpose financial statements, they fulfill the financial information needs of only specific users, not all the users. Who are that specific users? You have to explain in that audit report or refer to a note in the special purpose financial statements that contain that information. In case if that information is already disclosed in the special purpose financial statements, for which purpose this is getting prepared, who are the intended users, if that information is already explained in the special purpose financial statements, give a reference to that in your auditor's report. Next, if the management has a choice of financial reporting frameworks in the preparation of such financial statements, the explanation of management's responsibility for the financial statements should also make reference to its responsibility for determining that the applicable financial reporting framework is acceptable. Sometimes what will happen is management is required to prepare special purpose financial statements. That means they need to follow special purpose framework. And for that special purpose framework also two options are there. Like for example, according to some contract, the management of the company X Limited, they are required to prepare special purpose financial statements. And in the contract also, they have given two options. Either you can prepare special purpose financial statements as per one framework, option one they have given, or you can prepare the financial statements as per second special purpose framework. So like this, sometimes what will happen is you will be required to prepare special purpose financial statements, but for that also management will have multiple options that you have to explain. If such option is given to the management, that you have to explain in the management responsibility paragraph. In your audit report, you will give management responsibility paragraph. No, there you describe here management is preparing financial statements as per special purpose framework. There also multiple options are available and they are responsible for choosing such option which is best, that you have to describe in your management responsibility paragraph in your auditor's report. Once again, this is also not a new thing. This we have anyhow discussed it in our regular class itself. Now comes the new part. Till here, whatever I have explained, that thing is there. That thing is already there in the existing material also. Now we are coming to what things were added. So as I have told, just references. They have given reference to SS 701, 720 and 706. So what do you mean? What do you mean by that? Like for example, if you are giving your audit report on the special purpose financial statements, and if you feel like on the audit report there is a requirement to include key audit matter paragraph. In case if you feel that whatever audit report you are giving on special purpose financial statements, in that you want to include key audit matters, then comply with the requirements of SS 701. Then comply with the requirements of SS 701. That's all. Similarly, in case if the special purpose financial statements, whatever special purpose financial statements that you have audited, that is getting published along with some other information. Like for example, management is preparing some booklet here, an annual report kind of thing they are preparing. In that annual report, so much of information will be there. Like there will be some financial analysis, there will be some ratio analysis. In that annual report, one part is special purpose financial statements. So if that is the case, whatever information that is there in the special purpose financial statements and other information along with which this special purpose financial statements are getting published, whether both are consistent, both are matching, or there are any discrepancies are there or not, we have to check. If there is any discrepancy, we need to check whether special purpose financial statements need modification or other financial information needs modification. If the management is not doing the respective modification, you don't give your opinion. You don't give modified opinion. You don't give unmodified opinions. You give modified opinions. Basically, where all this discussion is there in SA 720, it is there. So now even you are required to comply with SA 720 also. In case if the special purpose financial statements is getting published with other information, whatever your responsibilities are there in SA 720, that responsibilities also you have to fulfill. Nothing else. That's what they try to say here. Next one. Next, one more point. The auditor may deem it fit to refer in an other matter paragraph in the auditor's report on the special purpose financial statements to the auditor's report on the complete set of general purpose financial statements or to matters which are reported therein as per SA 706. Now, what do you mean by this? So, what do they say here is, say for example, there is a client X Limited. There is a client X Limited. Now, this company X Limited, they will prepare general purpose financial statements or not as per Schedule 3 and as per accounting standards. They will have general purpose complete set of financial statements. Now what they have done is, for this general purpose financial statements audit would have taken place, and for this general purpose financial statements audit report also will be there. Now what this X Limited has done is, for specific users, for special requirements, they have prepared special purpose financial statements. Now these special purpose financial statements are also getting audited. On these special purpose financial statements also audit report will be there. Now what they try to say in the paragraph which we have read is, if there is some information in the audit report of the general purpose financial statements, if you want to refer that in the audit report of the special purpose financial statements, you can refer it. And how you can refer it is by using the other matter paragraph. By using other matter paragraph as per SA 706. If I give you one example, see for general purpose financial statements, whatever have been prepared, that audit has taken place. And in the audit report of the general purpose financial statements, the auditor has given one paragraph regarding material uncertainty relating to going concern. So this company is going through some material uncertainty relating to going concern. Regarding that, auditor has included a paragraph in the audit report of general purpose financial statements. Now you wanted to refer that. you wanted to give reference to that in the audit report on the special purpose financial statements also. Sir, how I can refer that? I'm giving an audit report on the special purpose financial statements. I want to refer this matter. Whatever matter which has been given in the audit report on the general purpose financial statements, that I want to refer it, sir, in my audit report on the special purpose financial statements. How can I do it? What you can do is, whatever audit report you do, in that you include a paragraph, other matter paragraph you included. In that other matter paragraph, you explain. So this is the audit report on special purpose financial statements. However, there is audit report on general purpose financial statements also. In that audit report, auditor has included a material uncertainty relating to going concern paragraph. You can kindly refer to that. So like that, you can give reference in other matter paragraph as per SA 706. That's it. These are the only 3 points which were added when it comes to the audit reporting section. So what are they? In case in the audit report on the special purpose financial statements, you want to include key audit matter paragraphs included, but follow the requirements of SA 701. In case that special purpose financial statements which you are auditing, that is getting published with other information, check the consistency and apply the requirements of SA 720. In case in the audit report which you are giving on the special purpose financial statements, you want to refer to some matter which is given in the audit report of complete set of general purpose financial statements, you can give the reference. How you can give the reference? By including an paragraph, other matter paragraph in your audit report as per SA 706. That's it. These 3 points are amendments. Not just that, as we all know, since the special purpose financial statements are done with a specific purpose, they are only intended for specific users. They will not fulfill the information needs of all the users. It is not fulfilling the information needs of all the users. Just they should be used by specific users. It is not meant for everybody. That you have to alert it. Those who are reading the special purpose audit report, you have to alert them. Boss, this is not for everybody. These financial statements are only for specific users. You have to alert it. Sir, how you can alert it? So that's what they're trying to say here. So how I can alert it? Alerting the readers that the financial statements are prepared in accordance with special purpose framework. You have to give an alert. So the special purpose financial statements may be used for purposes other than those for which they are intended. We prepare special purpose financial statements with a specific purpose, but sometimes it might fall in the wrong hands. They might do wrong interpretations. So that's why, to avoid the misunderstanding, and also the auditor alerts the users of the auditor's report that the financial statements are prepared in accordance with the special purpose framework and therefore may not be suitable for other purposes. This initially they told. This discussion was there previously only. Now what they have added is where to alert, how to alert. So in the amendment, what they have told is how you can alert is you add an emphasis of matter paragraph as per SA 706, and in that emphasis of matter paragraph you highlight it. This audit report and this financial statements are only for specific users, only for specific purpose, not for everybody. In the previous also, before revision also, they told us alert it, but they did not say how to alert. Now they are saying how to alert. How to alert it? You add a paragraph, emphasis of matter paragraph, and in that paragraph you highlight that. Clear? That's it. So this is what regarding SA 800. So as you could see, guys, very limited amendments are there. Just 3 points they have told in report. For comply the requirements of 701, 720 and 706 other matter paragraph. And one more point what they are trying to say is if you want to alert the readers regarding the specific purpose, so what you have to do, you alert the readers through emphasis of matter paragraph. That's it, as per SA 706. Understood? Now let us come to SA 805, which is talking about special considerations when you are asked to conduct audit of a single financial statement. Like someone is coming to you and asking you to conduct audit of only P&L, only balance sheet, only notes. Or if someone is coming to you and asking you to conduct audit of specific element, like someone is asking you to conduct audit of only revenue, someone is asking you to conduct audit of only trade receivable. So then what special considerations you have to keep in mind? So here also what they say here is, initially they told, if you are conducting audit of a single financial statement, like you are conducting audit of only P&L, if you are conducting audit of only balance sheet, then also to the extent applicable, you have to apply all the relevant standards. I might be conducting audit of only P&L. The client has asked me to conduct audit of only P&L, but I need to decide for conducting this audit of the P&L, which and all standards will become applicable. Which and all standards will become applicable that I have to identify, and I have to comply with all the relevant standards, whatever are applicable. Even though I am conducting audit of a single financial statement, even though I am conducting audit of a specific element account of a financial statement. Now they have given extension specifically which standards might become applicable. Even though you are conducting audit of a single financial statement item, even though you are conducting audit of a specific element, which standards might become relevant for you. So which standards might become relevant for is SA 240. Like if whatever specific item you are conducting, whatever single financial statement you are conducting audit, in that fraud could have taken place. So that's why SA 240 might become relevant for you. Similarly, say for example, if a client is asking you to conduct only audit of revenue, now there might be related party transactions. The client might have done related party transactions. Sales might be done with related parties. Then SA 550 might become applicable. Sometimes you might be conducting audit of one specific item or one single item which might have impact on the going concern. If that is the case, SA 570 will become applicable. If that is the case, SA 570 will become applicable. So this one line they have added. Nothing but this is not at all important if you ask me. So it is just an extension of the first point. In first point, what they told, even though you are conducting audit of a single financial statement or specific element, consider all standards which are relevant for you. Now in the second point, they're giving a hint which is standards might become relevant for you, even though you are conducting single financial statement or specific element of financial statement. So which standards might become relevant for you? SA 240, SA 550 and SA 570, these might become relevant for you. Not at all an important point, just an extension of the previous point. Similarly, you might be required to fulfill some communication requirements. We have SA 260. SA 260 says there are some matters which are required to be communicated with the management. There are some matters which are required to be communicated with those charged with governance. So in case if you are conducting audit of a single financial statement, in case if you are conducting audit of a specific element of the financial statement, identify what matters you are required to communicate as per SA 260. Identify who will fall under management to whom you have to communicate. Identify who are those charged with governance with whom you are required to communicate. And as we have discussed in SA 260, sometimes both the roles will be played by same people. In many organizations, management and those charged with governance, both the roles will be played by same category of persons. If that is the case, you need to make some modifications to your communication requirements as per SA 260. So fulfill all the requirements of SA 260 also. Just an extension. This is also not anything new here. One more reference they are telling which more standard might be relevant to you in case if you are conducting audit of a single financial statement or specific element. So if I have to club together second and third points, they have given examples of 4 standards which might be relevant for me even though I'm conducting audit of a single financial statement or specific element. What are they? 240, 550, 570, 260. Clear? Next one. So this is the thing here added. Now coming to the next item. These are all repeated points. 5, 6, 7, 8. This is anyhow they are existing in our current material also. But anyhow, I'll quickly take you through what are these points. So when you are conducting audit of a single financial statement or specific element of a financial statement along with audit of the complete set of financial statements. So what you are doing is, so you are conducting audit of complete financial statements also. Like for example, some X Limited is that this company has prepared complete financial statements. That audit you have only done. Later, company asked you to conduct audit of only P&L also. So if you are the person who is conducting audit of complete financial statements and you are also conducting audit of a single financial statement or specific element, can I use the evidence, whatever I have gathered in the complete financial statements? Yes, obviously you can use it. Obviously you can use, there is no restriction at all. In case if you are the person doing audit of complete financial statements and also specific element or single financial statement, undoubtedly you can make use of evidence, whatever you have gathered for complete financial statements audit. And even for single financial statement and specific element also, you have to plan and perform. You have to prepare your strategy, plan and program. And even here also, you need to obtain sufficient and appropriate audit evidence. Nothing new here. Sometimes the client might ask you to conduct audit of a single financial statement item, but you can't do it single-handedly because that item might be related with another item. Say for example, client is asking you to conduct only revenue, but revenue is linked with the trade receivables. So you need to analyze. In case whatever the client is asking you to do, many items of the financial statements will be related. So sometimes if the client says, no, you verify only revenue, you need not verify trade receivables, we will not give you bad debts data. In those cases, it might not be practically possible to accept such engagement for me. So think about it once. That's what they say here. So the individual financial statements that comprise a complete set of financial statements are all interrelated. Accordingly, when auditing a single financial statement or specific element of a financial statement, the auditor may not be able to consider the financial statements or the element in isolation. So in those cases, you need to perform audit procedures even on interrelated items also. And even one more point, they talk about materiality. So generally, we set the materiality for the financial statements as a whole while we are conducting audit of complete financial statements. In case if we are asked to conduct audit of a single financial statement or specific element, for this engagements also I need to decide materiality. Whatever materiality that I decide for these kind of engagements will be generally lower than the materiality which I set for my complete financial statements audit. Quite common sense, no? So whatever materiality which I said for audit of complete financial statements, that will be a bigger figure. So if I was asked to conduct engagement of single financial statement or specific element, I will fix the materiality only in its context. So my materiality amount will be lower or not. That's it. That's what they say. So further, the materiality determined for a single financial statement or for a specific element of a financial statement may be lower than the materiality determined for the entity's complete set of financial statements, and this will affect the nature, timing, and extent of audit procedures. Right. Next. Now coming to the opinion. So if you have conducted single financial statement or specific element after you have done all your audit procedures, after you have performed your audit evidence, now you need to form an opinion, and that opinion is required to be expressed in the form of audit report. So how you have to form your opinion, what should be the contents of the audit report? So that's what we are going to see now. Number one, when you are forming an opinion, when you want to give audit report on the single financial statements or a specific element of the financial statements, you have to comply with the requirements of SA 700. SA 700 is talking about audit report. You have to comply with the requirements of SA 700. Along with that, in SA 800 also, they give a few more points regarding audit reporting. That also you have to comply. So whenever you are giving audit report on single financial statement or specific element of the financial statement, you are required to comply with the provisions of SA 700, and also you are required to comply with the provisions of SA 800. Both the standards you are required to comply. Not just that, you need to check. So as per SA 700, in case if you are conducting audit of a single financial statement, you need to evaluate whether the financial statements provide sufficient disclosures, whether necessary disclosures are given to help intended users to understand the impact of the transactions and events of the information presented. So for a single financial statement or a specific element, it is crucial that the statement or element along with the related notes provide adequate disclosure. While conducting audit of complete financial statements, we check whether all the financial statements give complete disclosure or not, sufficient disclosure or not. Similarly, if you are conducting audit of a single financial statement or specific element regarding that single financial statement, regarding that specific element, proper disclosures are given, which will help the intended users to understand them in a correct perspective. So basically, checking of the disclosures. Second point, they say checking of disclosures. Next, going concern. Sometimes you might be conducting audit of a single financial statement or specific element, and that might have a impact on going concern of the entity. If any such impact is there, even though you are conducting audit of a single financial statement, even though you are conducting a specific element of the financial statement, if that item or that single financial statement is having linkages with the going concern, then even you are required to comply with the SA 570 requirements also. SA 570 also will become applicable, provided that part of the financial statement which you are conducting audit that might have significance regarding going concern. If any going concern matters are getting impacted, then you have to comply with 570 requirements also. Now, once again, if you want to include key audit matters, follow the requirements of SA 701. Similarly, if this information is getting presented along with other information, comply with the requirements of SA 720 also. SA 720. So whatever we do in the normal audits, similarly, if the single financial statement or specific element is getting published along with other information, then check for the compliance with SA 720 also. And then finally, after you have prepared all your report, you have to sign it. Signature of the auditor is required. So audit report shall be signed. If an individual person is conducting the audit, that individual will sign the audit report in his personal name. If a firm is appointed as an auditor, then the partner, whoever is signing on behalf of the firm, that person will sign in his personal name, and also he will mention the name of the audit firm. See, if an individual, say for example, if Mr. A, if he is appointed as an auditor, he will sign in his personal name. Say for example, ABC and Co, a firm is getting appointed as an auditor. On behalf of this firm, Mr. A is signing the audit report. Then he will sign in his personal name. Along with that, he will also mention the name of the firm, ABC and Co. Not just that, along with your signature, you have to mention your membership number. In case if you are signing on behalf of the firm, you have to mention the registration number of the firm also. Understood? Then what else they say here is sometimes, okay, let me put it like this. Next point, I will try to give you background discussion, then we will read the content. That will become much clear. Say for example, there is a client X Limited. There is a client X Limited. This client has prepared complete financial statements, and that financial statements audit has taken place, and for that complete financial statements audit report is there. And say for example, this client, because of some specific purpose, they are asking you to conduct audit of a specific element. Say for example, they are asking you to conduct audit of only trade receivables. Now these are trade receivables, you have to conduct audit, and on that trade receivables you have to give your audit report. Now what they say here is, there is an audit report on the complete financial statements. No, see, in that audit report, which is there on the complete financial statements, that auditor has given some comments. That auditor has given some negative comments or something he has told regarding trade receivables. Regarding trade receivables in the main audit report, he has given some comment. Since you are also conducting audit of that specific element, here also you are conducting audit of only trade receivables, don't you think you have to consider these implications in your audit report? What auditor tried to say in the complete financial statements regarding trade receivables that you need to consider in your audit report on the trade receivables or not? Definitely. So basically, whatever comments he tried to give, that I will try to incorporate even in my audit report of the trade receivables also. So sometimes whatever information that has been published in the audit report of the complete financial statements that might have implications on the audit report of a single financial statement or a specific element, then I need to consider those implications also. On the other hand, sometimes they might not have any implications. Let us take the same example. So complete financial statements are prepared. Auditor has done the audit. He has given the audit report regarding trade receivables. But say, for example, you are not conducting audit of trade receivables. The client has asked you to conduct a specific element like loans. The client has asked you to conduct audit of only loans and advances. Now, whatever main auditor has told regarding the trade receivables in the complete financial statements, that will not have any implications. That I need not consider at all while conducting the audit of the single or specific element of the financial statements. Able to understand? So in case if you are conducting audit of a specific element or single financial statement, sometimes there will be implications of items which will be included in the audit report of complete financial statements. If yes, then consider that implications, give proper disclosures in your audit report. If there are no implications, you can ignore it. So whether it will have implications or not, that depends on certain factors. Whatever matters that are in the audit report of the complete financial statements, whether they will have an impact on the single financial statement audit or a specific element of the financial statement audit or not, it depends on some factors. Considering those factors, if you feel that yes, it is having implications here, then consider that implications. If you feel that if you don't have any implications, then don't consider it. That's it. If I have to put it in simple terms, this is what they try to say here in the next two paragraphs. But the language will look complex. Here the language is looking complex. The concept is very, very easy. So like if you see here, 7th and 8th point, if you read it, this SA requires the auditor to consider the implications, if any, of certain matters which are included in the auditor's report on the complete set of financial statements for the audit of a single financial statement or specific element of a financial statement. Sometimes you might be required to consider the implications of matters which are there in the audit report of the complete financial statements in the audit report of single financial statements or a specific element of the financial statements. Considering whether a matter includes the auditor's report on the complete set of financial statements is relevant or not, it depends on professional judgment. So whether a matter which is included in the main audit report, whether it will be relevant for the single financial statement or specific elements audit or not, it is depending on professional judgment and it depends on various factors. Sir, what are that various factors they are trying to say here in the 8th point? So 7th and 8th point both are related. So 7th point says you need to consider the implications of matters which are included in audit report of the complete financial statements. But whether they will have implications or not, how you will decide, that depends on various factors. What are that factors that they are trying to explain the 8th point? So it depends on various factors like nature of the matters. It depends on a kind of matter. Like as I have told, if it is regarding trade receivables and if you are also conducting something regarding trade receivables, that is relevant. If you are not doing anything regarding trade receivables, then it will become irrelevant. Yes or no? So it depends on nature of the matter that is being described in the audit report. It also depends on pervasiveness of the matter, whether it is a small item or a bigger item or very bigger item, that depends on that. It also depends on nature and extent of the differences between applicable financial reporting framework. So it also depends on according to which applicable financial reporting framework complete set of financial statements are prepared, according to which applicable financial reporting framework single financial statement or specific element is prepared. That also will decide. And it also depends on extent of differences between the periods covered by the complete set of financial statements or single financial statements. For what period you are preparing complete financial statements, for what period you are conducting audit of single financial statement, on that also it will depend whether it is relevant or not. And also it depends on the time elapsed since the date of auditor's report on the complete set of financial statements. So in case if there are any comments in the main audit report, so what is the date? So when this main audit report was given, from that point of time, how much time has elapsed till the time I'm giving the audit report on single financial statement or specific element, even that depends on the time elapsed also. So all these factors the auditor will consider, then he will consider the implications. So basically 5 factors they will try to say here. So what are the 5 factors? It depends on nature of the matter, it depends on the pervasiveness, nature and extent of the differences, extent of difference between the periods covered, and also the time which has been elapsed from the date of audit report on the complete financial statements. Clear? So sometimes what will happen is, sometimes what will happen is there will be some crucial matters. There will be certain crucial matters which might not have direct implications. In the previous paragraph, we have seen when matters will be considered to have implications. Sometimes what will happen is there will be certain matters in the complete financial statements that might not have direct implications for the audit of the single financial statement or specific element, but still you feel it appropriate to refer to them in the audit report on the single financial statements. If there are any such matters, like for example, how I have to tell you, okay, I will give you one example. There is a company Y Limited. This company Y Limited prepare complete financial statements. For that complete financial statements, audit has taken place. In that audit report is also given. In the audit report, there is one paragraph regarding material uncertainty relating to going concern. Material uncertainty is a very broader matter. It is not related to one specific thing. It is a very broader thing. Now, say for example, you are conducting audit of only revenue. The client has asked you to conduct audit of a specific element, only revenue. Now, it is not having any direct implication. The matter which is there in the main audit report, that is not having any direct implication. But still you thought better if I include it somewhere in my audit report on this revenue. Even though it is not having direct implications, you might feel it appropriate to include this information in your audit report on the single financial statement or specific element. So if you have such a thing, if you find certain matter which is not having direct implication, but still you feel it appropriate to disclose that in your audit report of the single financial statement or specific element, that you can do it. How you can do it? Whatever audit report you give on the single financial statement or specific element, in that audit report, you include an other matter paragraph. You include an other matter paragraph as per SA 706, and in that other matter paragraph, you explain it. So in the main audit report on the complete financial statements, the auditor has given material uncertainty relating to going concern paragraph. Please go and refer to that. So like that, if you want to include anything, you can use the other matter paragraph. So that's what they say here. Once again, if I read it slowly, see, I have added all these examples also. You can refer to these examples. I'm telling you, no. So language looks complex, but the concept is very easy. Just you need patience when reading. If you have that patience, no, you will understand it. So even when certain matters included in the auditor's report on the complete set of financial statements, they do not have implications for the audit or auditor's report on single financial statement or specific elements. But still, the auditor may deem it appropriate to refer to them in an other matter paragraph in the auditor's report as per SA 706. Then, in case if you are the person who is conducting audit of single financial statement, you are also the person whoever is conducting the audit of complete financial statements. Both the audits you are only doing. So let us take this case. Both the audits you are only doing. Can I give one single report for both? No, you have to give separate opinion in 2 separate reports. You can't combine it. This is a existing thing only. This is not anything new here. Yeah, that's what they say. The auditor shall express a separate opinion for each engagement. And one more thing. Sometimes what will happen is complete financial statements and its audit report and single financial statement or specific element along with the audit report, this information can be published together in a single document. Sometimes what will happen is complete financial statements along with audit report and the separate financial statement or specific element along with the audit report, they might be published in a single document. In that case, as an auditor, what is your responsibility is you need to ask the management to clearly differentiate the two. See, both can be published in the same document, but proper bifurcation should be given. That means people should be able to identify that, okay, these two are two separate assignments. People should be able to identify. We should check, even though they are getting published in the same document, proper differentiation has been done. If you find that management did not do proper differentiation, management did not properly bifurcate the information, then you should insist the management to bifurcate it. If they are not bifurcating it, you don't give your reports. Until the management bifurcates it, you don't give your reports. So that's what they try to say here. This is once again not a new information. This is also something which is already there. In the existing material also it will be there. Nothing new here. But once again, if I read it for the sake of your convenience, the audited single financial statements or audited specific element of a financial statement may be published together along with entities audited complete set of financial statements. But however, if the auditor concludes that presentation of a single financial statement or the specific element of financial statement does not differentiate it sufficiently from the complete set of financial statements, you should ask the management to rectify the situation. The auditor shall also differentiate his opinion on the single financial statements from the complete set of financial statements. The auditor shall not issue the audit report containing the opinion on the single financial statement or specific element until satisfied with the differentiation. Clear, everybody? Right. So now coming to the next part. So what do they say here? Right. Just I will try to present this thing in the summary. Okay. Right. So what do they try to say here? First case, say for example, as I've told, an entity will have complete financial statements. Entity will have complete set of financial statements. That complete set of financial statements will undergo audit. And in that audit, audit report also will be given. Say for example, there is a company X Limited. For this company X Limited, complete financial statements are there. Balance sheet, P&L, cash flow statement, statement of changes in equity, notes to accounts, all the complete financial statements are there. For that, audit has taken place. In that, audit report is also given. For the same client, the client is now asking you to conduct audit of only P&L. Single financial statement, they are asking you to do the audit. Single financial statement, they are asking you to do the audit. But the problem here is whatever audit report that has been given on the complete set of financial statements, that contains a qualified opinion. That contains which opinion? That contains a qualified opinion. Or that contains an emphasis of matter paragraph. What else they say? That contains an emphasis of matter paragraph. Yeah, that contains a modified opinion, basically qualified opinion. Or it contains an emphasis of matter paragraph or other matter paragraph. Or it contains an material uncertainty relating to going concern paragraph as per SA 570. What else they say? Or it contains some declaration by the auditor regarding SA 720. Some negative remark is there regarding SA 720. Basically, this complete financial statements along with it audit report is also published, but there is some discrepancy. Annual report is also getting published. There is some discrepancy regarding that. He has given one negative comment. There is some uncorrected misstatement in the annual report. So audit of complete set of financial statements has taken place. For that, audit report is given. But in the audit report on the complete financial statements, either there is a qualified opinion, or there is an emphasis of matter or other matter paragraph, or there is a material uncertainty related to going concern paragraph, or there is some negative remark as per SA 720. Now for the same entity, you are conducting audit of a single financial statement or specific element, but you are satisfied. Say for example, P&L audit only you are doing. In the P&L audit, you are not able to find out any material misstatement. Everything is perfectly fine. Everything is perfectly fine with regard to P&L. Now what you can do on that single financial statement or on that specific element, you can happily give unmodified opinion. On that single financial statement or on that specific element, you can give unmodified opinion. You can give it, no problem. But what you should state is, in that audit report, what you should state is, you should state that the main audit report on the complete financial statements, it contains a qualified opinion. And what is the basis for qualified opinion? You have to explain. Or if it contains emphasis of matter or other matter paragraph, in this audit report, you have to say the main audit report contains emphasis of matter or other matter paragraph. And what is the matter which is included in the emphasis of matter or other matter paragraph, that you have to explain it here. Similarly, if the main audit report contains material uncertainty paragraph, you have to explain that here, that the main audit report contains material uncertainty paragraph and what is that matter, that you have to explain. And similarly, if it contains any negative remark regarding SA 720, that also you have to give a reference here. The main audit report contains SA 720 negative remark and what is that remark, that you have to explain. Able to understand? So simply what they say here is, if the main audit report on the complete set of financial statements either contains a qualified opinion, or it contains an emphasis or other matter paragraph, or it contains material uncertainty paragraph or negative remark as per SA 720. But for the same entity, you are conducting audit of a single financial statement or a specific element. If you are satisfied, everything is okay, you can give unmodified opinion. No issue, you can give unmodified opinion. But in that audit report, you have to state, basically you have to give references that the main audit report contains these information. You have to give the references and you can give unmodified opinion. No objection at all. So that's what they try to say here. That's what they try to say here. So if the audit report, if the auditor's report on the entity's complete set of financial statements includes either a modified opinion or emphasis of matter paragraph or other matter paragraph, or it contains an material uncertainty relating to going concern, or a statement that describes an uncorrected misstatement, then the auditor shall consider the implications, if any, that these matters may have for the audit of single financial statement or the specific element. So nothing but whether these will have an impact or not, you have to check. If there is no impact of these items on my single financial statement or specific element, I can happily give unmodified opinion. But as I have told, you have to give references. That is implied here. Next one. And one more thing, one more case they try to say here. So one more case what they try to say here is, say for example, you are conducting audit of the client Y Limited. For this client Y Limited, there is complete set of financial statements. For that, audit has taken place, and for that audit report is there. But in the audit report, either there is adverse opinion or either there is disclaimer of opinion. Extremely negative opinions are there on the main audit report. Then what the standard says is, for the same entity, if you have been asked to conduct audit of a single financial statement or specific element of a financial statement, in that case, even though you are satisfied with that single financial statement, or even though you are satisfied with a specific element of the financial statement, you can't give unmodified opinion. You can't give unmodified opinion. Even though you are satisfied, you can't give unmodified opinion. They have prohibited. They have prohibited. However, they gave you relaxation. In exceptional circumstances, they have told. Generally, if the main audit report contains adverse opinion or disclaimer of opinion, for the same entity, if you are conducting single financial statement or specific element, you can't give unmodified opinion. But however, you are very insisting. You are very much insisting. You are insisting that no, even though in my complete financial statements, adverse opinion or disclaimer of opinion is there, but of single financial statement, whatever I have verified, or that specific element, whatever I have verified, that is free from material misstatements, I want to give unmodified opinion. If you are very much insisting on it, you can do that only if three conditions are satisfied. Only if three conditions are satisfied. Number one, that information should not be published together. That single financial statements or specific entity should not be published together. And there should be no restriction from law or regulation. I think that is a condition. Yeah, there should be no prohibition. There should be no prohibition from law or regulation. Similarly, that single financial statement or specific element should not contribute major portion. That should not constitute major portion. That should be a small item. That should not be a major portion. If these three conditions are satisfied, sir, main audit report is there. In that main audit report, adverse or disclaimer of opinion is there. But still, for the same entity, I have conducted audit of a single financial statement or specific element. Whatever specific financial statement I have conducted audit, whatever specific element I have conducted the audit, that is not containing any misstatement. I want to give unmodified opinion. Generally, you can't do it, but you can do it only if three conditions are fulfilled. There should not be any prohibition from law or regulation. That information should not be published together along with the complete financial statements, and it should not constitute a major portion of the financial statements. So that is what the summary of this entire paragraph. So if you see here, if the auditor concludes that it is necessary to express an adverse opinion or disclaim an opinion on the entity's complete set of financial statements, SA 705 does not permit the auditor to include in the same auditor's report an unmodified opinion on a single financial statement or specific element. They have prohibited it. This is because such an unmodified opinion would contradict the adverse opinion or disclaimer of opinion. However, if the auditor concludes that it is necessary to express an adverse opinion or disclaimer of opinion on the complete financial statements, but the auditor feels that it is appropriate to express an unmodified opinion on that specific element, you can do it only when it is not prohibited by law or regulation, when it is not published together, and when it does not constitute a major portion. So this paragraph, whatever you are supposed to read, that it will be exact replica of the previous paragraph only. So that's what the auditor shall not express an unmodified opinion on a single financial statement if it is not, if it is not even though if it is not published together, but if it is constituting a major portion, if it is a constituting major portion, then also you cannot do it. Which means in order to give an unmodified opinion on that specific element, all the three conditions should be fulfilled. Number one, there should not be any prohibition. It should not be published together, and it should not constitute a major portion. When all the three conditions are satisfied, then only you can express a unmodified opinion. Able to understand? Clear and comfortable, everybody? And one more relaxation also they have given. This point also I will try to explain. If the auditor's report on the entity's complete set of financial statements, the expression of a disclaimer of opinion regarding the results of the operations and cash flows were relevant, and an unmodified opinion regarding the state of affairs is permitted, since the disclaimer of opinion is being issued in respect of results of operations and cash flow only, not in respect of financial statements. So what they are telling is they have given one more relaxation. So what is that relaxation? You know, there is one company, Z Limited. They have complete financial statements. For that, audit has taken place. for that audit report is given. In that audit report, the auditor has given disclaimer, but that disclaimer of opinion is regarding P&L. Operating results means P&L, or that disclaimer of opinion is regarding only cash flow statement. In the complete financial statements, the main auditor has given disclaimer of opinion regarding P&L or regarding cash flow statements only. Now, for the same entity, you are supposed to conduct audit of balance sheet, state of affairs. You are required to conduct audit of only balance sheet. In that case, they are permitting you, if you are conducting audit of a balance sheet and you are satisfied that in the balance sheet there is nothing wrong, you can give unmodified opinion. Why? Because whatever disclaimer of opinion that has been given in the complete financial statements, that is related to statement of P&L, that is related to cash flow statement. And in case for the same entity, if you are conducting audit of balance sheet, not P&L, not cash flow statement, then also you can give unmodified opinion. This relaxation has also been given. That is what the meaning of this paragraph. Clear? So with this, we have completed SA 805 as well. Now we will try to understand SA 810. SA 810 we will try to understand. Once again, very simple standard. This we can wind it up in just 10 to 15 minutes. We can wind it up. Okay, right. So now we will try to have a look at SA 810. So very simple once again. So like the way we have understood SA 800 and SA 800 and SA 805 amendments, we will also try to cover SA 810. So as you all are aware, SA 810 is going to talk about how to conduct engagements on which you are required to report on summary financial statements. But here we have seen one thing: if you are the person whoever has conducted the audit of complete financial statements, then you should only conduct the audit of that summary financial statements also. So that is one condition we have seen. So along with that, here also in this particular standard, they have given some extra points regarding the report. So whenever you have conducted the audit of the summary financial statements, and on that summary financial statements, if you are giving the report, how your audit report should look like, what and all should be the contents of the audit report. So here in this area, there are a few added points. Let us try to quickly have a look at that thing. So the auditor's report on summary financial statements shall include the following elements. What elements should be there? Number one, clear title. So definitely 100% for the audit report, a clear title is required. And addressee. So you should be addressing this, through this report, you are expressing your opinion. And who is your addressee, that you have to identify. And one more thing specifically they say here, if the addressee of the summary financial statements is not same as addressee of the auditor's report on the audited financial statements, the auditor shall evaluate appropriateness of using a different addressee. That means in the complete financial statements, you are addressing to different persons, and in the summary financial statements, you are addressing different person. You need to evaluate whether it is appropriate or not. And so who should be the appropriate addressee? That depends on various factors. Like it depends on factors that may affect the auditor's evaluation of appropriateness of addressee of the summary financial statements include. It depends on terms of the engagement, nature of the entity, and the purpose why the summary financial statements are getting prepared. So whatever it is, first we need to have title, then we need to have addressee, then you have to identification of summary financial statements on which auditor is reporting, including the title of each statement included in the summary financial statements. Basically, you have to identify on which summary financial statements you are reporting, what are the titles of, what are the elements of that summary financial statements, just like normal audit report only. Next, even you have to identify the main financial statements. From the complete financial statement summary is prepared now. So even you identify that complete audited financial statements. Then you have to clearly express your opinion. So what is your opinion on the summary financial statements? You have to express that opinion. And you have to add one statement indicating that summary financial statements do not contain all the disclosures. So all the disclosures will be there in the complete financial statements. This is just an extract of that complete financial statements, and this summary financial statement do not contain all the disclosures. That statement you have to add. And if required, then a statement that summary financial statements and the audited financial statements do not reflect the effect of events, nothing but subsequent events. Here it does not include any subsequent events. That disclaimer also you can add. That caution also you can add. After the balance sheet date, whatever events after the auditor's report, or after the balance sheet date, whatever has simply from the auditing standards perspective, after the date of auditor's report, whatever events have taken place, our report is not having any issue with that. Our report is not covering any of the events or subsequent to the date of auditor's report. That disclaimer also you can add, that caution also you can add. And even you have to give a reference to auditor's report on the audited financial statements. On the main financial statements, you have to give reference to that audit report. What is the date of the main report and whether it contains an unmodified opinion or modified opinion, that you have to include it. And also management responsibility paragraph that you are required to add. Auditor's responsibility, simply you will add one line that auditor is responsible for expressing an opinion based on your audit procedures. and even you have to put your signature. Along with your signature, UDIN is also required to be included. And what should be the date of auditor's report? The date of auditor's report. So if you are giving summary financial statements, if you are giving audit report on summary financial statements, the date of audit report should not be earlier than the date of obtaining sufficient and appropriate audit evidence. Why? Because we all are aware the sequence is first we perform audit procedures, then we get audit evidence. After getting audit evidence, we give our audit report. So the date of audit report on the summary financial statements should not be earlier than date of obtaining audit evidence. Why? Because first we need to obtain audit evidence, then only we can give audit report. And one more thing also they say here, the date of auditor's report on the summary financial statements should not be earlier than the date of audit report on the main financial statements. So from the complete financial statements only summary financial statements will be prepared, right? So whatever is the date of auditor's report on the complete financial statements, after that only the audit report on the summary financial statements should be dated. So that's what they say here. The auditor shall date the auditor's report on the summary financial statements no earlier than. That means the date of audit report on the summary financial statements should not be earlier than the date on which auditor has obtained sufficient and appropriate audit evidence on which to base the opinion, including evidence that summary financial statements have been prepared and those with the recognized authority. Basically, prior to the date of obtaining audit evidence, you should not date it. Similarly, it should not be earlier than the date of auditor's report on the audited financial statements. Audited means complete financial statements. Along with all the contents, even you have to include the place of signature also. You have to mention the place wherever you are signing. So these are all the contents of auditor's report. Okay, next one. Now, one more thing here. Yes, the next all content I will try to summarize in one simple paragraph. Starting from here, this entire B point I will try to summarize in the form of one single chart. The same kind of chart which I have explained even in our regular classes also, even in the revision videos also, you'll be able to find it. The same kind of chart I will use. See, when we are conducting audit of summary financial statements, what is our objective is we need to check whether summary financial statements are consistent with complete financial statements or not. Whatever information that has been presented in the complete financial statements, whether it has been consistently summarized without any deviations, without any mistakes, whatever information that has been published in the complete financial statements, the same information should be summarized even in summary financial statements also. That's what, on that we are actually expressing an opinion. So whatever information which is there in the complete financial statements, whether it is correctly summarized in the summary financial statements or not, on that we are required to express opinion. Now, there could be two cases. So when I compare summary financial statements with the complete financial statements, there could be two scenarios possible. Number one, summary financial statements are consistent. Summary financial statements are consistent with complete financial statements. That means whatever information is there in complete financial statements, the same information is summarized even in summary financial statements also. Or other case which could be possible is summary financial statements are not consistent, are inconsistent. That means in the complete financial statement some information is there, but in the summary financial statements some different information is there. Why? Because see, when I say summary financial statements, it is not some new financial statements. Summary financial statements is a summarized version of actual financial statements. So whatever figures, whatever totals, whatever information which is there in the complete financial statements, that only should be there in the summary financial statements. Say for example, in the complete financial statements, the total of the assets is 100 CR. But in the summary financial statements, they are showing the total assets as 80 crores only. Should it be possible? It should not be possible. Why? Because in the summary financial statements, we are just summarizing whatever information which is there in the complete financial statements. Yes or no? So that's why they should be consistent. In case if you find any inconsistency, if the summary financial statements are not consistent with complete financial statements, here the standard says directly give adverse opinion. Directly give adverse opinion. If the complete financial statements and summary financial statements both are inconsistent with each other, directly give a adverse opinion. So that's what they say here. That is this paragraph. Modified opinion on summary financial statements. If the summary financial statements are not consistent in all material respects with or not a fair summary of the audited financial statements in accordance with applied criteria, and the management does not agree to make necessary changes, then the auditor shall directly give adverse opinion. Next. Sir, what if they are consistent? Sir, summary financial statements are consistent with the complete financial statements. But here I need to check. Whether audit report on complete financial statements either contain a qualified opinion, or few more things they say. Either it contains a qualified opinion or it contains an emphasis or other matter paragraph. Emphasis or other matter paragraph. What else? Material uncertainty relating to going concern, or it contains a material uncertainty relating to going concern paragraph, or it contains SS 701 key audit matters as per SS 701, or it contains negative comment as per SS 720. Some wrong information is there as per SS 720. If it is the case, summary financial statements are consistent. Whatever information which is there in the complete financial statements, the same information is summarized in the summary financial statements. But the problem is, on the complete financial statements, whatever audit report that has been given, that either contains a qualified opinion, or that contains an emphasis or other matter paragraph, or that contains a material uncertainty relating to going concern, or that contains a key audit matter paragraph, or that contains a negative remark as per SS 720. In that case, there is no problem. On the summary financial statements, you can give unmodified opinion. On the summary financial statements, you can give unmodified opinion, but in that report, you have to give reference. You have to give reference. You have to give reference to what? You have to give reference to the previous things. Like, so even though we are giving unmodified opinion here, but on the audit report on the complete financial statements, there is a qualified opinion, or there is an emphasis of matter or other matter paragraph, or there is a material uncertainty relating to going concern, or there is a key audit matter in the main audit report, or there is a negative remark as per SS 720 in the main audit report. That reference you are required to provide. You are permitted to give unmodified opinion, but you are required to give references. Sir, where it was stated, so like if you see here, where the auditor's report on the audited financial statements contain a qualified opinion, or an emphasis of matter or other matter paragraph, or a material uncertainty relating to going concern, or key audit matters, or a uncorrected misstatement in other information as per SS 720. But the auditor is satisfied that the summary financial statements are consistent in all material respects with or a fair summary of the audited financial statements in accordance with applied criteria, then you can give unmodified opinion, no problem. But you have to state in the audit report, you have to state that main audit report contains either an emphasis of matter paragraph or other matter paragraph, or it contains a qualified opinion, or there is a material uncertainty relating to going concern, or there is a key audit matter, or there is an uncorrected misstatement, that you have to state it. We have to mention. You give unmodified opinion, but mention the fact that the main audit report contains this information. Not just giving a fact, even you have to disclose if the main audit report contains a qualified opinion, what is the basis why this qualified opinion has been given. That also you try to explain it. Not just that, if you are referencing a emphasis or other matter paragraph or material uncertainty paragraph, you explain in summary what is that matter which has been highlighted. That also you give a brief here. And in case if you are saying there is a key audit matter, where is it? No. So in case if you are referring, there is a uncorrected misstatement, there is a mistake as per SS 720 in the main audit report, that also you contain some summary, that also you add some information. Able to understand? So in case, see, this is anyhow theirs, guys. This is already there in the previous version also. Just a little bit tweaking they have done. I don't want to go into the details. I will explain you the amended provisions. So very simple provision. Summary financial statements are consistent with consolidated financial statements, but complete financial statements. But in the complete financial statements, there is any of this. If that is the case, still you can give unmodified opinion on the summary financial statements, but you have to mention in your audit report that in the main audit report, these things are there, and also briefly explain if it is a qualified opinion, what is the basis. If there is any of these matters, explain that matters in brief. If there is any uncorrected misstatement, explain about that also in a brief. But however, what is that one more case is, in case if the summary financial statements are consistent with the complete financial statements, but audit report on that complete financial statements contains either an adverse opinion or disclaimer of opinion. Main audit report, consistent only, whatever information which is there in the complete financial statements, the same information is summarized even in the summary financial statements. But the problem is, the audit report on the complete financial statements, it contains either adverse opinion or disclaimer of opinion. Then what does the standard say? So when the auditor's report on the audited financial statements contain an adverse opinion or disclaimer of opinion, then the auditor's report on the summary statements shall additionally state that auditor's report on the audited financial statements contain an adverse opinion and disclaimer of opinion. So you have to state in your audit report on the summary financial statements that main audit report contains adverse opinion, main audit report contains a disclaimer of opinion. Not just that, even explain what is the basis for giving adverse opinion in the main audit report, what is the basis for giving disclaimer of opinion. And one important thing they say here, so you have to describe the basis for opinion, but one important thing they say here, state that as a result of adverse opinion or as a result of disclaimer of opinion, it is inappropriate to express an opinion on the summary financial statements. So in this case, you should not express an opinion, but you have to add one statement that it will be inappropriate to express an opinion and we will not express opinion on the summary financial statements. That fact you have to mention. You are not permitted to express your opinion in case the audit report on the complete financial statements contains an adverse or disclaimer. You have to mention in your audit report on the summary financial statements that the main audit report contains adverse or disclaimer. Explain the basis also. Don't express any opinion on the summary financial statements. Add a statement. It will be inappropriate to express an opinion on the summary financial statements. That line you have to add. So basically the standard has prohibited for you. Just a minute. Basically, the standard has prohibited you to express any opinion if the main audit report contains an adverse or disclaimer of opinion. Understood? But however, if any of these things are there, then you can give unmodified opinion, but you have to give reference. Sir, what if main audit report contains unmodified opinion? Then no issue only, no. If the main audit report contains unmodified opinion, if the summary financial statements are consistent with the complete financial statements, then no issue only. You can happily give unmodified opinion. No need to give any extra references or anything else. Understood? However, if it is completely inconsistent, that means complete financial statement says something else, summary financial statement says something else, directly give the adverse opinion. When they are consistent, then you check what is the status on the main audit report. Understood? So this entire exhaustive information, whatever has been explained in these paragraphs, in this simple chart, I have tried to summarize. This chart is also not new for you. I think in our main class also, in our regular session also, I have tried to explain this entire concept in the form of this simple chart only. For that simple chart, I have done one little addition. So what addition I have done is this addition I have done. So initially when I explained, they told only about qualified opinion. They did not add these things. Now these things were added. That's all. Okay. So if you are my regular class student or if you have already followed my previous revision videos, you'll be able to relate it better. Okay. Nice. What else is there? Timing of work, events subsequent to the date of auditor's report on the audited financial statements. This I will try to tell you. In simple form. Say for example, I'm an auditor. I have conducted audit of the financial statements 24-25. As you all know, the person whoever has conducted audit of complete financial statements, the same person is also required to complete the audit of summary financial statements also. Now what they are trying to say here is, say for example, financial year 24-25 ended 31st of March 2025. This is end of financial year. Now complete financial statements were audited. Audit report on complete financial statements has taken place on, say for example, audit was completed on 15th of April. Audit report on complete financial statements was given. Now later you conducted audit of summary financial statements. On that also you have given audit report. You gave the audit report on 20th of April. Now whatever events that have taken place, even for conducting audit of complete financial statements or even for conducting audit of summary financial statements, those events which have taken place till the date of main audit report, only those events are relevant for you. You need not worry about any of the events which have taken place after the date of audit report on the complete financial statements. Okay, so till here, whatever events have taken place, only those events you are required to consider while giving the audit report on the complete financial statements or even giving the audit report on the summary financial statements. Understood? If at all any event has taken place after 15th of April, the information which you have it on the date of auditor's report, you would have given a different opinion. Like that, if you come across any events, then anyhow we know SA 560 will become applicable here. SA 560 will give guidance regarding subsequent events. That SA 560 requirements you are supposed to follow. SA 560 requirements you are required to follow. So generally, your responsibility as an auditor, both for conducting audit of complete financial statements and also for conducting audit of summary financial statements, the cutoff date is the date of audit report on the complete financial statements. You are supposed to concerned about events only which have taken place till here. If at all any event has taken place after this date, but if you feel that this information, if I have known it earlier, I would have given a different opinion. As we all know, in those cases, SA 560 will become applicable. You have to check the compliance with the requirements of SA 560. You have to perform all the audit procedures as per SA 560. You have to obtain audit evidence regarding the subsequent events. So that SA 560 requirements will become applicable. That's what they try to summarize it here. So you can ignore all that paragraphical discussion. Just stick with this diagram. That itself they try to convey it in that detailed and lengthy paragraphs. Okay. That's all, guys. This is what regarding specialized areas. So we have successfully completed amendments in the specialized areas. So as you would have observed, there are not very significant, here and there little bit of changes are there, but that are also manageable. If you ask me, those are also manageable, not very troublesome changes, I will say. Okay, right. So successfully we have completed specialized areas also. Fine. Okay, so shall we proceed further now? Let us do it. Now we will try to cover the chapter audit of banks. I will say here in the audit of banks, they have given one small addition, but not that important from the examination perspective. So what actually the amendment here in the chapter audit of banks is, as we all are aware, if we are conducting audit of a bank, we know that banks are required to comply with the CRR and SLR requirements. They need to deposit certain amount in the specified investments, or they need to keep certain amount of money with the Reserve Bank. That we call it as CRR or SLR. And we need to calculate that CRR and SLR as a percentage of demand and time liabilities. We have to calculate that CRR and SLR as a percentage of demand and time liabilities, right? So that's what we have learned in the audit of banks chapter. Now what they have told us, when you are checking, what audit procedures you need to perform in order to check whether CRR and SLR requirements have been fulfilled by the banks or not. So what audit procedures you will perform. So regarding that audit procedures, a few additions, a few extra points they have added. So what points they have added, that I will tell you first. See, these all things are same. So what suggested audit procedures for checking compliance with CRR and SLR requirements? As an auditor, if you are conducting audit of a bank, what procedures you will perform to check whether your client bank has complied with CRR and SLR requirements or not? Now, uniform points are this one, this point, this point, this point. These are all same. These are all same. This is even there in our existing content also. Like you have to obtain an understanding of circulars or instructions. RBI on a periodical basis, they will give circulars, how to calculate CRR, how to calculate SLR. They will give circulars. So as an auditor, I need to obtain an understanding of all the recent circulars or instructions. Then request the branch auditors to send their weekly trial balance. See, generally CRR and SLR will be calculated fortnightly. So as on every Friday, every branch has to prepare, they should request the branch auditors to send their weekly trial balances. And based on that weekly trial balances, the detailed positions will be calculated on every Friday. And as an auditor, as a central statutory auditor, you need to request the branch auditors to verify whether the trial balances of their respective branches are correct or not. No new point, guys. This is also something which is already there. Then even examine on a sampling basis, you need to check the consolidations regarding detailed positions. Now from all the branches you receive the trial balances. Now these whatever information you got from the branches, that will be consolidated, that will be combined, and the position for the entire bank will be calculated. And on that CRR and SLR rates will be multiplied. So on a sampling basis, you check whether these consolidations at the central level is happening properly or not. This is also same. Now where the things have changed is, see, what should be excluded while calculating that DTL position, demand and time liabilities, whenever we are calculating, what things should be excluded, what things should be included. See here, what things should be excluded, what things should be included, and also what are exempted. So while completing the DTL position, some items will be exempted. That means on these things, you need not calculate the CRR and SLR ratio. So what are that exempted? In these area, the list has been revised. They have added few things here. Okay, so instead of focusing on what has been added, what has been newly added, so what I have done is I have reflected the entire information. So what should be excluded from calculating the detailed position, what should be included while calculating the detailed position, and what are that exempted categories while computing that detailed position. So if you ask me, there is nothing I have to explain it here. This is purely a remembrance game. This is purely remembrance. So you have to simply remember this. You have to simply by heart it. So once again, not that significant from the examination perspective. There is no concept here for you to apply. So I would say you can go through it once on your own. So all these things have been covered. So just it is a purely remembrance game, guys. So there is nothing concept I have to explain. But still, if you insist me to read, I will read it for the sake of your convenience, but nothing much here. So if I read it quickly, sir, what will be excluded from calculating the detailed position? Like you have to, what should be excluded? So P&L, paid up capital should be excluded, reserves, credit balance in the profit and loss account of the bank, amount of any loan which I have taken from RBI, and amount of refinance which I have taken from Exim Bank, NHB, NABARD, SIDBI. These should not be included in your demand and term liabilities. Bills are discounted by a bank with eligible financial institutions as approved by RBI. Don't include it. Exclude it. Net income tax provision. Income tax provision should not be included. Amount received from DICGC towards claims held by banks pending adjustments thereof, that also should not be included. Amount received from ECGC by invoking the guarantee, don't include it. Amount received from insurance companies for ad hoc settlements, don't include it. Amount received from court receivers, don't include it. Net unrealized gains or losses arising from derivative transactions. From the derivative transactions, if you have any unrealized gains and losses, not realized ones, unrealized gains and losses, if you have any, don't include it. Income flows received in advance, such as annual fees and other charges which are not refundable. So basically, if you are receiving any income well in advance which are non-refundable, that also you don't include it. Liabilities arising on account of utilization of limit under bankers acceptance facility, don't include it. Part amounts of recoveries from the borrowers in respect of debts considered bad and doubtful of recovery. You initially classified certain debt as bad and doubtful of recovery, but fortunately you have got back that amount, part amount you have recovered, that also don't include in the demand and time liabilities. Amounts received in Indian currency against import bills and held in sundry deposits pending receipt of the final rates. Sometimes you get the money in the bank, but since the final closing rates are required to be finalized, at what rate this conversion should take place, that is pending. So that's why the amount has been still kept in the bank account. That also you don't include it in the demand and term liabilities. And unadjusted deposits, balances lying in link branches for agency businesses like dividend warrants, interest warrants, refund of application money, blah blah blah. Nothing but as per Companies Act. What the company will do, all the dividend amount they will transfer it to a dividend account. So that money also lying with the bank, no, can they also consider that while calculating DTL? No, not required. So whatever money has been deposited in your company for distributing it as dividend, whatever money that has been deposited by the companies for refund of the application monies, so these are all require immediate disbursal. You don't include that for calculating CRR SLR ratios in DTL position. And similarly, margins held and kept in sundry deposits for funded facilities. Even margins also don't include it. So these are the things which are required to be excluded from DTL position. Similarly, specifically, they have told certain things which are required to be included. Specifically, they have asked you to include certain things. In that, one addition is this one. In this point, they have done one addition. Remaining all are same. Like net credit balance in branch adjustments accounts, that you have to consider, that you have to include it in the DTL position. Interest accrued on deposits should be calculated on each reporting fortnight as per the interest calculation method applicable, whether or not such interest is accounted for in the books of accounts, even though whether they have recognized that interest in the books of accounts or not, but you have to calculate that interest accrued and you have to consider that in the DTL position, so that bank's liability in this regard is fairly reflected in the total NDTL of the same fortnightly return. And borrowings from abroad by banks in India need to be considered. If the Indian bank is having any borrowings from abroad banks, that should be included. And one more thing here, in India needs to be considered as liabilities and should be considered at gross level. You should not net it off. If you have any liabilities from bank outside India, that liabilities in that banks you have some assets also. Like for example, SBI is there, some Citibank is there, foreign bank is there. With the Citibank, they have some borrowing. From Citibank, they have some borrowings. Say for example, they have some 100 millions of borrowing from Citibank. But with the Citibank, they have FD also. They have some 50 millions of FD. Now, can they knock off and consider 50 million as DTL position? No, you have to take it at the gross level. You should not net it off against the asset. With respect to borrowings from abroad by banks in India, you have to take the gross figure. You should not net it off. Next, you have to do proper reconciliation of the notes to accounts. That notes to accounts, that foreign accounts and all has to be reconciled properly. And there are some exempt categories. While examining the computation of detail, the auditor may specifically examine details of exempt categories. See, on these exempt categories, you are not required to consider them for CRR and SLR calculations. So what are that exempt categories? Minimum eligible credit and outstanding long-term bonds to refinance to finance infrastructure loans and affordable housing loans as per RBI circular. The eligible amount of increment FCNR and NRE deposits of maturities of 3 years and above. The auditor should also verify loans out of FCNR, the B deposits and interbank foreign currency deposits, blah, blah, blah. So these also are exempted category. And one more thing is what? As per some circular, for conversion of foreign currency assets, reference rate from FBL should be taken. In case if the reference rates are not available, you can take the New York closing rate for conversion of such currency into USD. So that one thing they have told. Next, a few other things, few other procedures. Examine whether consolidations prepared by the bank include relevant information in respect of all the branches. Branch adjustments account. These are all common, guys. So here you will not find any amendments and all. So these are all common points. These are even there, even in our existing content also. So only things where the changes have taken places when it comes to exclusions list, and when it comes to inclusions list, and when it comes to exemptions categories. This is where the things have been amended. Rest of all the things are going to remain common. So this is what regarding amendments in the chapter audit of banks. And one more area which people are very much worried is, sir, in NBFCs also there are so many amendments. No guys, there are no many amendments are there. Limited amount of changes are also there in audit of NBFC. So that also we'll try to cover it. So when it comes to NBFC, no, at many places there is only change in the circular reference. Earlier there used to be some different circular. Now recent circulars have come. Recent RBI directions have come in the year 2023 and 2024. At various places they have changed that reference to the circulars. They have given reference to the recent directions. In our older version of the study material, we used to have references. So they are asking you to maintain some amount of NOF and all. No. So earlier they used to give reference to the previous circulars. These circulars were there in 2016. But recently some new circulars have been released by RBI. At various places they have changed that reference to the circulars. That is what the amendment, which I don't feel it has anything significant. Just they have changed the reference to the circular. Okay, so many amendments you will find it like that. Anyhow, we will go through them once we start reading the content. So first there is one change in NOF limits, net owned funds. As we all know, NBFCs are required to maintain net owned funds criteria. So what is that net owned funds criteria? So RBI has prescribed a timeline to meet NOF amount of INR 10 crore in a phased manner for certain categories of existing NBFCs by 31st of March. So what are that NBFCs? So if you see here is the gliding path, as you could see. So NBFCs which are falling under ICC category, current NOF limit is only 2 crore rupees. But by March 31st of 2025, they have to increase their net owned funds to 5 CR. By 31st of March 2027, they have to increase their net owned funds by 10 CR. Similarly, NBFCs and microfinance institutions, current NOF is only 5 crore, whereas in any region it is 2 crores only. By 31st of March, they have to increase to 7 crores or 5 crores in case of any region. By 31st of March 2027, they are also required to increase their net owned funds to 10 CR. And NBFC factors, for them current NOF is 5 CR. By 31st of March they have to increase to 7 crores, and by 31st of March 2027 they have to also increase their net owned funds by 10 CR. So this is important for MCQs. This might be important for MCQs. Don't expect them to ask a direct theory question from here. Might be important from MCQs. And one major amendment here is for NBFC IFC and NBFC IDF NBFC, the NOF should be 300 CR. So for these two categories of NBFCs, for NBFC's IFC investment thing company and IDF NBFC, for these two categories of NBFCs, the net owned funds shall be 300 crores. Okay, right. Prudential norms. When it comes to prudential norms also, there are some changes. So as you could see here, every applicable NBFC, they shall maintain a minimum capital ratio consisting of tier 1 and tier 2 capital, which shall not be less than 15% of its aggregate risk weighted assets on balance sheet and of risk adjusted value of off balance sheet items. So basically every NBFC, they are required. However, there are some exceptions. We'll talk about the exceptions later. NBFCs are required to maintain a minimum capital ratio considering both tier 1 and tier 2 capital, both put together. Tier 1 and tier 2 capital, both put together. They should have a minimum capital ratio which shall not be less than 15%. That means it should be greater than or equal to 15%. That much minimum capital ratio they have to maintain. However, in case of NBFCs MFI, microfinance institutions, and NBFCs primarily engaged in lending against gold jewelry at any point of time, they should not have less than 10% of minimum capital ratio. For normal NBFCs, other than these two, NBFC MFI and NBFCs which are primarily engaged in lending against gold jewelry, they need to have a minimum capital ratio of 10%, both tier 1 and tier 2 put together. For all other NBFCs, they need to have a minimum capital ratio put together, tier 1 and tier 2, not less than 15%. Sir, what will be included in tier 1 capital? What will be included in the tier 2 capital? So this is all the same. This is all as it is. There is no such major change in here. So what is included, what is not included? This is just a list of items. I think you can go through it. So what and all should be included, what and all should not be included in the tier 1 and tier 2 capital. And amendment here is this one. So in case of other secured loans, how much percentage of weight you have to assign? Here two things they have added. Consumer credit exposure, outstanding as well as new, which are categorized as retail loans, that too other than housing loans, education loans, vehicle loans against gold, jewelry and microfinance or SSG loans. For these exposures, the weight which should be given is 125% weightage should be given. And for credit card receivables, 125% of weightage should be given. So we will calculate that risk weighted asset position. No, in that 15%, 10% we have to calculate. So there what they have told us, they have added two items in the assets. One is consumer credit exposure, which is categorized as retail loans. But however, in this, what will not be included? Housing loans, educational loans, vehicle loans, and loans against gold, jewelry, and microfinance or SSG loans. These should not be included. Apart from that, whatever other retail loans are there, for them, the weight assigned is 125%. For credit card receivables, the weight assigned is 125%. So this is one change they have done. Okay, next. What else? In the asset classification, some changes are there. So as we all know, asset classifications are there like standard, substandard, we have doubtful, we have loss, we have. So there some changes have taken place in the substandard and substandard. Doubtful, loss assets remain the same. In the substandard, there is one amendment, there is one slight change. In NPA definition also there is one slight change. And for doubtful also there is one change is there. So what are they? First I will talk about NPA. So when an asset will be classified as NPA, in that what changes there is, previously they told everywhere they have told 6 months. Previously they told 6 months. Now what they have done is that 6 months they have replaced with 180 days. The entire definition remains the same, but only changes. Previously they told that, like if you read it previously, it used to be like an asset in respect of which interest has remained overdue for a period of more than 6 months, they used to say. Now what they have told is an asset in respect of which interest has remained overdue for a period of more than 180 days. Similarly, a term loan inclusive of unpaid interest where the installment is overdue for a period of more than 6 months. Previously, they used to say, now they have told 180 days. So that is the only change here, guys. The entire definition remains the same. But previously, they used to use the phrase 6 months. Now they have replaced all that 6 months term with 180 days here. That's the only change. So currently, NPA norms, an asset will be classified as NPA if it remains overdue in different circumstances for more than 180 days. But however, the above period of 180 days should be reduced. RBI has given a guidelines. Currently, we are saying up to if an asset remains overdue for more than 180 days, then we classify it as NPA. But slowly, they are reducing that 180 days span of time to 90 days. To 90 days. That also they are doing it in a phased manner. By 31st of March 2024, the assets will be classified as NPA if they remain more than 150 days overdue. By 31st of March 2025, they will be classified as NPA if they remain overdue for more than 120 days. By 31st of March 2026, if they remain overdue for more than 90 days, then they will be classified as NPA. So currently, previous circular used to contain 180 days, but slowly RBI is trying to bring the NPA norms of NBFC also at par with the banks. Also at par with the banks, they want to bring it, but they want to do it in a phased manner. By 31st of March 2026, they are expecting NBFCs also to classify the assets as NPA if they remain overdue for more than 90 days, but they are slowly doing it in a phased manner. By 31st of March, more than overdue for more than 150 days. By 31st of March 2025, they remain overdue for more than 120 days. But by March 31st, 2026, they will have to bring it to 90 days. Okay, clear and comfortable, everybody? So this is what regarding amendment in the NPA classification. Now, when it comes to substandard, in the substandard definition also they have changed one thing. So, an asset which has been classified as NPA for a period not exceeding 18 months, except for NBFC middle layer and above. So, if you remember, NBFCs will have 4 layers. One is base layer, then we have middle layer, then we have upper layer, then we have top layer. For those NBFCs other than NBFC middle layer and above. So, for those NBFCs, an asset will be classified as substandard if it remains in NPA category exceeding 18 months. If it exceeds 18 months, then it will be classified as substandard. But however, for those NBFCs which are in middle layer and above, for them, an asset will be classified as substandard category if it remains NPA for a period not exceeding 12 months only. For a period not exceeding 12 months. So very simple, guys. For other than NBFC middle layer and above. For other than NBFC middle layer and above, an asset will be classified as substandard if it remains in the NPA category for not exceeding 18 months. That means up to 18 months, if it remains in the NPA category, it will fall under substandard category. For NBFCs which are in middle layer and above, for them, they will remain in the substandard category if they remain NPA only up to 12 months. Understood? Next. And also they have one more thing. An asset where the terms of the agreement regarding interest or principal have been renegotiated, rescheduled, or restructured after commencement of operations. Nothing but some person has taken the loan, but they are unable to repay the principal or interest. So they have come and renegotiated, rescheduled, or restructured their loans until the expiry of 1 year of satisfactory performance under the renegotiated, rescheduled, or restructured terms. They will remain in the substandard category. Terms have been rescheduled, but until 1 year of satisfactory performance, till the time you get the satisfactory performance and you maintain that satisfactory performance for a period of 1 year, till that point of time, your account will remain in the substandard category only. There is no amendment here. This point remains the same. And provided that classification of infrastructure loans as a substandard asset shall be in accordance with the provisions of circular. So they have changed the directions. Earlier the reference used to be there for 2016 directions. Now they have changed the reference to 2023 directions. What is there in that? We are not required to worry about it. Just there is a change in reference. Then doubtful asset. So when an asset will be classified as doubtful. So this is also, here also there is one change. So if it is other than NBFC, middle layer and above, as I have told, up to 18 months they will remain in the substandard category. If it is more than 18 months, if it has remained in the NPA category for more than 18 months, then that will become doubtful asset. For however, NBFCs who are in middle layer and above, if it remains in NPA category for more than 12 months only, it will fall under doubtful asset. Just an extension of the previous point. So for this NBFCs and above, for NBFCs middle layer and above, up to 12 months, it will remain in the substandard category. If it exceeds 12 months, doubtful category. Other than NBFCs middle layer and above, up to 18 months, they will remain in the substandard category. More than 18 months, if they remain outstanding, then it will become doubtful category. Understood? So that's all. This is what regarding provisioning asset classification. Now, when it comes to provisioning norms for loss assets, the provisioning requirements are same. For doubtful assets also, the provisioning requirements are same. For substandard assets also, the provisioning requirements are same. For standard assets, the provisioning requirements have changed. So what they have done is, NBFC's base layer shall make a provision of 0.25% of their outstanding outstanding standard loans. So if you are a NBFC falling under base layer category, you shall make a provision of 0.25% even on your standard assets also. Similarly, standard asset provisioning not applicable for NBFC's upper layer. NBFC shall make a provision for standard assets at 0.4% of the outstanding in case of other NBFCs, guys. For NBFC base layer, 0.2%. For other than NBFCs which are in the base layer, that means basically middle layer will come, upper layer will come. Middle layer will come, upper layer will come, top layer will come. However, they are telling not applicable for NBFC's upper layer. So if you include that upper layer, NBFC's middle layer and NBFC's top layer, they shall make a provision of 0.4% of the outstanding. Able to understand? So this is some percentage changes are there. For NBFC's base layer, 0.25%. For other NBFCs, are not applicable for NBFC's upper layer, they have to make a provision of 0.4% of the outstanding amounts. Next, a few more things if I have to keep in place. Yeah, here they have changed the reference to the directions, not at all important. Here also they have changed. See here, just there is a change in the reference of the directions. Just there is a change here. And one thing here, every NBFC is required to get a statutory auditor certificate that they have the certificate of registration under section 45IA and it is eligible to hold it. This certificate they have to get it from their statutory auditor. Now there is a change in time limit. Within what time limit this certificate has to be furnished? There is a slight change in the time limit. So what is the time limit is? A certificate from the statutory auditor in this regard with reference to the position of a company as at the end of the financial year ended March 31st may be submitted to the regional office of a department of non-banking supervision under whose jurisdiction the non-banking financial company is registered. And here is the amendment: within 5 working days from the date of signing of the audit report in terms of the section 134 of the Companies Act, but not later than December 31st of any year in any case. So what they're trying to say here is, if you are a statutory auditor of an NBFC, for that NBFC company, you will give an audit report now as per the Companies Act. So from the date of that audit report, within 5 working days, you have to submit that certificate that NBFC has complied. NBFC is holding the certificate of registration and it is eligible to hold it. So that certificate you have to give within 5 working days from the date of signing of the auditor's report. But at last, by By latest, you have to do it by, not by latest, but not later than December 31st. At any case, you have to give it on or before 31st of December of the same year. So within 5 working days, you have to do it. Sir, if I fail to do within 5 working days, what will happen? You can still do it, but some consequences will be there. Facing that consequences, you can still do it till 31st of December of that year. Okay, right. So this is what slight change here within 5 working days from the date of signing of the auditor's report. This is amendment. So once again, the chance of getting tested in the form of MCQs. Right. Next. What else is there? This is also one point where just they have changed the reference. They have changed the reference to the directions. Even I have given the point numbers also. You can go and cross verify with the material. With the main material, you can verify. So capital adequacy ratio have to be maintained. Earlier they used to give different 2016 directions. They used to give the reference. Now they have changed the reference to directions 2023. Here also same. Just there is a change in reference of directions. Here also same. Just a change in reference. And previously NBFCs are required to furnish a return on deposits with the RBI. Previously the form used to be NBS 01. Now it has been changed to DNBS 01. DNBS 01. Previously it used to be NBS 01. The return on deposits NBFCs are required to file, but now they have changed it to DNBS 01. So that is the return which they have to furnish. One more point we have. So this is also nothing but just a change of reference of directions. This is also just a change in reference. Nothing but previously there used to be 2016 directions that they have updated it to 2024. So I don't think this is something which you need to remember. And applicability of Ind AS. Previously they used to give limits for which NBFCs Ind AS will become applicable, but now they have told NBFCs are required to comply with Ind AS as per Rule 4, Sub-Rule 1, Clause 4 of the Companies Ind AS Rules 2015 and as amended by the Companies Indian Accounting Standards Amendment Rules of 2023. Previously in the material they have given limits. Only NBFCs which have exceeded these limits, they are required to comply with the Ind AS. Now they have given one simple paragraph. NBFCs, or they did not give any limits. Directly they have told NBFCs are all required to comply with the Ind AS rules and regulations. Understood? So this is what regarding the amendments in the NBFC chapter. So as you could see here, nothing so much conceptual. So if you are feeling it clumsy, we can take the risk here. That 1 or 2 marks in this NBFC chapter, we should be willing to take that risk here. Okay, right. Next. What else we have? Professional ethics. We have in the professional ethics, what are the amendments that you already know? If you are my student of regular class, I have already explained it. CA logo, we used to have older CA logo where we used to have one box. So in that box, CA used to be there in blue letters and tick used to be there in the green letter. But that CA logo has been amended. So this is our correct logo now. Previously, we don't used to have this Indian flag. We don't used to have this India, and just only one green tick used to be there. I have explained this in our regular class only. But at that point of teaching regular class, at that point of time only new logo has been released by ICA, but it was not yet updated in the ICA's books. Now they have explained the same thing in the form of amendment. So this is the revised logo. Going forward, we are supposed to use this logo. So we have to use the term CA in blue letters, and that audit tick will be there in tricolor to represent India. And beneath our logo, even India, this text is also added. So this is what the logo. Regarding this logo, they say certain things. Even they have given the color code and all. So as you could see, guidelines issued in 2023 for using the new CA India logo for CA members prescribe that the logo consists of the letters CA in blue color with a tricolor tick mark upside down with white background. The blue color not only stands out as stand out on any background, but also denotes a creativity, innovativeness, knowledge, integrity, trust, blah blah blah. They're telling what is the background behind using that blue color. Okay, anyhow. The upside down tick mark typically used by chartered accountants has been included to symbolize the wisdom and value of the professional, and India is also added in the logo as it epitomizes the institute's connection to India first approach and commitment to serve the Indian economy. There should be no alteration of the font. You should not change the colors according to your choice. Even they have released the color codes also. These color codes only have to use. Even there should not be any change in spacing and dimension. You should not add extra space. That also you should not do. Do not change the design and colors, including the white background also. Refrain from rotating or tilting the logo clockwise or anti-clockwise. Even you should not do like this. You should not do like this. So you should not do any of this. The logo should not be shrunk or distorted, changing the original proportion. Like as you could see here, this CA India has been cut here. So all these kind of things also you should not do. Note, while members are encouraged to use the new CA India logo as published on letterheads, visiting cards, website, etc., a transition time of 1 year has been provided to use signatories, signage replacement, etc. So basically, they told we are giving a new logo, but up to 1 year, we will permit you to use the old logo. Within a span of 1 year, you have to change all your logos on your letterheads, visiting cards, and your name boards and all. Because we would have already stationery, no, we already have the stationery containing the old logo. So that's why government has given relaxation. Okay, use the current stationery up to 1 year, but within 1 year, once that 1 year expires, don't keep on using that old logo. Bring the new logo. So you have to bring this new logo on all your official stationery, name boards and all. And in addition to that, there are some recent decisions of the Ethical Standards Board. So all that I have given here. So what are they? From here, the questions might come. Very, very important. Please go through this recent Ethical Standards Board decisions before you go for the examination. It is not permissible for member in practice, being a statutory auditor, to prepare BRSR report. So as we have seen in SDG, ESG chapter, there will be one report called Business Reporting and Sustainability Reporting. If you are a statutory auditor of the company, if you are a member in practice, and if you are a statutory auditor of the company, you cannot prepare BRSR report study to the audit clients. However, he may provide advisory services. You cannot prepare, you cannot sign that BRSR report, but you can provide advisory services. You can advise the client on these issues, but you cannot prepare BRSR report. It is permissible for a member in practice, being a statutory auditor, to be an assurance provider on BRSR services. Basically, advisory services once again. Assurance services you can do, but you can't prepare BRSR report. Right. Next. Second one, statutory auditor of an entity is not permitted to engage in assignment of compilation engagement. We already know if you are a statutory auditor, can you do the compilation engagement for them? Can you prepare the financial statements for them? You can't do it. Self-review threat, no. That also they have clarified. So statutory auditor of an entity is not permitted to engage in the assignment of compilation engagement of that entity as per SRS 4410. Next, it is permissible for members in practice to engage in the service assessment or performance audit of centers of skill development council of Government of India, as these are permissible under management consultancy and other services. So as we all are aware, the government has given one broad category, management consultancy and other services. So you can offer, being a member in practice, you can also offer all those services which are falling under management consultancy and other services. So in that list of management consultancy and other services, they have added one more service. What is that one more service they have added? Services assessment or performance audit of centers of skill development council of Government of India. These engagements are also added in the management consultancy and other services. That means you can also perform these services being a member in practice. No issue. Nothing but one more item got added in the list of management consultancy and other services. Next, it is permissible for a member in practice to accept the assignment of mystery audit. Sir, what is this mystery audit means? Say for example, I'm running a restaurant. I have various branches all over India. I want to know whether the staff at my branches are handling the customers properly or not. Whether the staff at my branches all over India, whether they are handling my customers properly or not, I want to know. Then these restaurants, what they will do is they will do something called mystery audit. Nothing but they appoint some professionals. So what they will do is they will go to the branches as an ordinary customer. They will go to the branches, they will visit the branches as an ordinary customer, and they give the feedback, they give the report whether really the customers are getting handled properly or not. They don't disguise themselves as auditor in mystery. They remain as normal customers, go to the branches and try to get the service and check whether customer satisfaction is getting derived or not. So that services we call it as mystery audit. So what they have told, it is permissible for a member in practice to accept the assignment as a mystery audit. You can do that mystery audit also being a member in practice. Next, it is permitted for a member in practice to mention position as a promoter or director on the portal of the company. If you are a promoter of a company, if you are a director of a company website will be there, no? On that website, you can be mentioned. They can mention your name as a director or promoter, but however, you cannot mention in that website your professional attainments and the name of the firm with which you are associated. There should be no violation of clause 6 and 7 of part 1 of the first schedule to the Chartered Accountants Act in doing so. Just in the company's website, they are telling your name and they are telling that you are a director or promoter of the company. No professional attainments are getting displayed. No name of the firm is getting displayed. Then there is no violation. There is no clause 6 and clause 7 getting violated. You can do that. Next one, it is permissible for a member in practice to become professional director in the board of management of a cooperative bank. If you are a member in practice, you can also become a professional director in the board of management of a cooperative bank. For a cooperative bank, you can become a professional director. It is permissible for a member to set up practice in IFSC or gift city. So like if you are aware, we have this international financial service centers and gift facilities are there, right? In Gujarat, we have these things, IFSC or gift city. So there you can go and set up your practice, no issue. Next, it is permissible for a member to render professional services to IFSC units from offices outside of IFSC. So say for example, in Gujarat, we have that IFSC facility. So if you want to stay outside of the IFSC facility and you are providing services to the IFSC facility, that is also permitted. Staying outside of IFSC facility, you can also provide services to the IFSC facilities. Either you can go and set up the practice in the IFSC facility or gift city, or you can stay outside of the IFSC facility and provide the services to IFSC facility. That is also permitted. Next, a firm is not permitted to publish its vision or mission statement on letterheads. Definitely strictly prohibited. You should not publish your vision statements on the letterheads, visiting cards or stationery, etc. The vision and mission statement may be printed on the firm profile. Whatever profile you are sharing, on that you can mention a vision and mission statements. And if the client is requesting, and may be provided in response to a specific request. If the client is asking you to share that mission and vision statement, then you can share it. That too over a firm profile. You cannot display your mission and vision statement on your visiting cards, on your letterheads, on your stationery. You can't do it. It is not permissible for a member or firm being the statutory auditor of a bank to accept the assignment of ASM of a customer of the same bank simultaneously. He can accept either of the assignments at one time. So either you can be a statutory auditor or you can be a ASM. So you can be either a statutory auditor or you can be a ASM. So ASM full form I forgot. Just give me 1 minute. ASM means, yeah, Agency for Specialized Monitoring. So I forgot it. Agency for Specialized Monitoring. These are also some special services which will be rendered to the banks. So either you can be a statutory auditor or you can be a ASM, but you can't accept both the positions simultaneously. Then if you are a member in practice, you cannot be appointed as an internal auditor and procurement officer simultaneously. If you are a chartered accountant in practice, if you want to act as an internal auditor of a company, for the same company, you can't act as a procurement officer, either internal auditor or procurement officer. Next, it is permissible for members in practice to charge fees on percentage of utilization amount of an educational institute for certifying the amount spent by an educational institution out of grant. See, generally, we will be deemed to be guilty of professional misconduct if our fees is contingent upon the findings. But as you all are aware, there are certain services, there are certain engagements which are permitted to be done, where we will accept the fees as a percentage of outcome. There are some permissions, there are some exceptions. To that exception, one more has been added. One more item has been added to that list. So there are some engagement. Generally, if we accept any engagement where we are deciding the fees as a percentage of outcome, as a percentage of some revenue, etc., then we will be deemed to be guilty of misconduct. But however, there are some exceptions. There are some engagements where we can accept the fees as a percentage. There are some list of items given there. To that list, one more item is getting added. What is that one more item which is getting added? In case if you are performing the engagement of certifying the amount spent by an education institution out of grant. Say for example, some education institution is there. Somebody gave them a grant. Now say for example, they have given some 10 lakhs of grant to them. Now this education institution will spend that grant amount. Say for example, they have spent 8 lakh rupees of money out of that grant. Now I have to give a certificate. As a chartered accountant, this education institution has asked me a certificate to give me a confirmation whether they have really spent 8 lakh rupees of money or they have spent excess. Now I will give a certificate. Now what I can say is, so I am giving you the certificate. No, my fees will be 1% out of this money spent. Whatever money you have spent, no, on that 1% will be my fees. That is permitted. In these assignments, you are permitted to charge a fees as a percentage of amount utilization spent by education institution out of a grant. You will not be deemed to be guilty of misconduct. You will not face any consequences. So these are all some recent decisions which are taken by the Ethical Standards Board. Please refer to it before you go for the examination. From these, there will be definitely one question. From these 12 points, definitely there will be one question which will be tested in the examination. I do have a strong gut feeling for that. Okay, right. So this is what, guys, amendments for May 2025 attempt. I know this has been a bit late, so but I was occupied with various other things. But now finally I have taken out the time and done this. So hope you guys will learn from this. And please refer to this before you go for the examination. And as I've told, some extra questions are there in each and every chapter at the end of the chapter. So that also I have compiled. These extra questions also I have uploaded in the folder. So everything will be shared in the description of this video. So please do watch it. Please do learn from this and also solve the questions, solve that extra questions before you go for the examination. So definitely you will do the best in your examinations. All the very best. Bye, take care.